In this video, I'm going to teach you everything you need to know about liquidity. We're going to talk about liquidity on the higher time frames, how to find liquidity sweeps, runs, grabs, all that sort of stuff. And, I've been trading for years. I'm an ICT charter student. I can honestly say, out of everything I've learned in technical analysis, liquidity is by far the most important thing. And if you can really understand liquidity, you're 90% of the way there, right? These markets only move for liquidity, and it's so important that you understand liquidity. And in this video, I'm going to teach you exactly what you need to know so you can start making money today. Okay, so what is liquidity actually, right? We hear about this all the time, liquidity. What actually is it? It's simply highs and lows, right? Highs and lows. Most importantly, on the higher time frames, so the daily and the 4-hour, key highs and key lows will have lots of orders there. Now, what do we mean by orders? We mean stop loss orders. Now, why is that important? Stop loss orders will have billions of dollars, right? Remember, on the daily chart for gold, there will be billions of dollars at this low and this high, right? People shorting will have their stop losses here, and people going long will have their stop losses here. And by people, I'm talking about smart money. Now, smart money are large banks, large institutions, hedge funds, all that sort of stuff, who have billions of dollars, and they move the market. We don't move the market. Day traders don't move the market. Scalpers don't. It's them with billions of dollars. They move the market. And in order for them to actually get their orders filled, and what that means is for them to actually get into a trade, is they have to do business at key highs or key lows, right? That's it. That's what liquidity really is. So these markets will only move for higher time frame liquidity. And this is so important because so many people understand, key highs and key lows, but then they look at, the 1-hour key high and they think that's the most important thing, when they don't realize there's a key low on the daily chart the price is going for. And right, so we're on gold, we're on the daily chart, and we're going to look for the most obvious high or low that price is going to go for. And I hope it's pretty clear. Maybe it's a bit bigger. We're going to go for this low here. Now, why are we going to go for this low? Let's mark it out. There's lots of liquidity at this low. We know it's a key low. We know that gold's been in the bull market, right? So people have trailed up their stop losses here, here, and here, right? Some people might have had it here. But here, there's so much liquidity. There's so many orders here for smart money to target. And another thing you can do whenever you're unsure whether price is going to go for this low is just look at the order block, right? So we're going to look at this order block here. So I'm going to mark out the order block, which is just the last down close candle before the up move, like that, right? You see how price aggressively comes into it and wicks deep within it? That right there isn't really respect of an order block, right? Because what you would expect if it was a valid order block and we were still bullish, you'd expect price just to tap it with a wick and then quickly move off, right? But we don't have that. We have a massive, aggressive down close candle. And when you see candles like this and you see the candle closing into the order block and wicking deeply, that shows you there's complete disrespect of the order block. Right, we're not bullish in any way, sense, or form, right? Complete disrespect to this order block, and we've got key liquidity here. And you might hear this be called a liquidity pool, right, or whatever. The terminology is not important, but what we know is that for gold, currently, we're going to go for this key low. This key low, there's been no respect to the order block, and we've got this obvious key low. Now, what does this mean? Because so many people get this wrong. This right here is your daily bias, right? So we've already figured out daily bias just by using liquidity. We've used liquidity and we know our daily buys. Now that means when we get on the lower time frames, we're only going to look for shorts on gold. We're only going to look for shorts, right? So many people, they do this and then they start looking for longs on the lower time frames because it looks bullish. You don't do that. You only look for shorts. But, and this is so important, when we get in the lower time frames, we're going to look for liquidity sweeps. Right? We're going to look for liquidity sweeps. Now I'm going to explain more about that when we get onto the lower time frames. Okay, so we're in the lower time frames and most people understand what I just said in the higher time frames. They know we're bearish, but they always go wrong in the lower time frames. Now, why did they go wrong? Because they're not waiting for a liquidity sweep. Now, what is a liquidity sweep? And a liquidity sweep is, a liquidity run, liquidity grab, whatever you want to call it. It's the exact same thing. What it is we know we're bearish on the higher time frames. We've done the hard work, which is always on the higher time frames. We know the actual direction of the market, and we're looking for any reason to get short. Now, we're waiting for some sort of key high to be taken out because we're bearish. Now, why are we waiting for that? We know, right, and you've probably had this loads of times where you might have shorted here, right? You might have shorted at this order block, let's say. So this order block, the last up close candle for the down move, you might have put your entry right at this body here. You would have had your stop loss, maybe up here, and you would have targeted maybe this wicks low, like a 3 to 1 or something, right? How many times have you had the bias right, the direction right, the price literally will come down, go straight through to your stop loss, take out your stop loss right here, and then quickly reverse? Like, how many times does that happen? Because that used to happen to me all the time for years. Like, I would get the bias right, I knew exactly where it was going to go. Price would come, it would literally wick up, take out my stop loss, instantly reverse. The reason why that happens is because you're not waiting for a liquidity sweep. Now, what is a liquidity sweep? We know at this high here, there's lots of stop loss orders here. Lots of people have gone short on gold. They know from the higher time frames that we're bearish. So they've got the stop loss orders here. And I'm going to mark this out, right? Because this is so important. when price comes all the way like that, right? See this wick here? See this wick? So let me make this more obvious. See this wick? You see how it points up, literally comes out, takes out this high. Let me make this a bit more clearer. Right, comes up, takes out this high, instantly reverses. Look how aggressively we reverse. That right there is your liquidity sweep. Right, it pokes up, takes out the high, quickly reverses. That is your liquidity sweep. And this is really important. We don't know it's a liquidity sweep until around down here, right? Because once the wick comes and takes out the high, it is possible that price could have had a little retracement and continued up, right? But when we see a wick that just points up, just takes out that high, and then quickly reverses sharply, that right there tells you you've got a liquidity sweep, right? And what we really want to do is we want to enter on that retracement after the liquidity sweep. So I'm just going to mark out the liquidity sweep here, because you always, and this is so important, if you're a day trader, scalper, or even a swing trader like I am, you want to wait for a liquidity sweep before you enter, because if you don't wait for a liquidity sweep, you're going to get swept. So I'm going to mark this out, liquidity sweep. Right? And this is probably the second most important thing. Once you've got the bias, you need to wait for a liquidity sweep. Otherwise, you're going to be getting your stop loss taken. You're going to be right with the bias, and then you're going to lose, and then you're going to get angry, you're going to revenge trade, and you're going to keep losing and blow your account. All these things happen to all traders, and I don't want you to go through that. So we wait for the liquidity sweep, wait for the wick to take out the high, and then we're just looking to get short, right? And this isn't a video about entries. We've got loads of entry videos on the channel and stuff, but there's a fair value gap here, right? Easy fair value gap entry that you can take, right? So you put your entry right here to make this a bit more obvious. Put your stop loss at liquidity sweep high. Now, why do we do this? We talk about this all the time. Why do we do this? Because it's very unlikely, if we're bearish and we've had this liquidity sweep, right? Because remember, price only came up here just to take out that high. That's the only reason it came up there, was just to take out that high. Very unlikely that price is going to come down all the way down here, come up, take out this wick again, and then go back down. Very unlikely. It is possible. It does. The lower the time frame you go, so if you're on the 1 minute, and especially on indices, you'll see that a lot. It's like a double liquidity sweep. But for Forex, if you're on the 5 minute chart, very unlikely, right? Because price only came up here just to take out those stop loss orders. That's the only reason it went up there. It didn't go there for any other reason apart from just to wick up, take out those stop loss orders, so smart money could take the other side and ride price down. So it's super unlikely price going to come all the way up, take out your stop loss, and then reverse. So it's very safe to put your stop loss here. Very safe, right? Very unlikely that price is going to come up. And in terms of take profit, always target at least a 2-to-1. And for me, I say never more than a 3-to-1. Now, why do I say that? Because let's just at least target this low, right? Because lots of liquidity, and you ideally want to be targeting the opposing liquidity pool. Now, what does that mean? It means if you're bearish, you want to target the opposing low. And if you're bullish, I target some opposing high. Really doesn't matter, but for me, a 2 to 3-to-1 is absolutely fine. And if we target this low here, basically get a 3-to-1. Now, why do I say never to trade and never target more than a free risk reward for day trading and scalping, and even swing trading, really? Because look at this. Let's say you target a 4-to-1, right? You did everything right. You got the bias right in the higher time frame. You wait for liquidity sweep here, right? You wait for liquidity sweep. Perfect entry. Price comes all the way down, right? So it comes like that. You enter right here. Perfect entry. 3% up in profit, and it just chops like that. And then this is the end of the week, right? So it gaps up. Or it just reverses on you, right? Imagine that. Imagine how annoying that is. I'm telling you, all you need is a 2 to 3-to-1 consistently. Right? I have a 50% win rate and a free risk reward ratio. I'm profitable. I can make all the money in the world. 10k a month, 100k a month. $1 million a month maybe if I get enough capital. Like, I can make whatever amount I want, right? That's all you need. Most profitable traders have a 50% win rate and a 2 or 3 risk reward ratio. All these guys saying you need, a really tight stop loss, massive risk reward. It's a load of crap. It's a load of crap. And that's because they have a tiny win rate. If you do this, you're going to get a good win rate. And yeah, always be realistic. Aim for a 2 to 3-to-1. And I'm going to give you another example on gold too. Okay, so here's another example in gold. And this is such an important example because someone was asking me, right? And let me just make this clear, right? So right here, let me mark this out. Right here is your liquidity, and here is your liquidity sweep. Price pumps up, quickly moves down. Now, someone was asking me, let me mark this out. Someone was asking me, does a liquidity sweep or run or grab, does that always have to be a wick? Right? Does it always have to be a wick that just points up like we had in the last example and quickly reverse? No, it can be a body as long as it aggressively reverses, right? Now, what does that mean? Right, look at this, right? So price literally pokes up. I know we get a body, and then it quickly and aggressively moves down, right? And then moves up and like that, right? You get big fair value gaps in the opposite direction. And when you see that, when you see price pumps up and aggressively moves in the other direction, and it leaves lots of fair value gaps, that tells you it was a liquidity sweep. Right, it was a fake move. The only reason price went up here was just to take out these relative equal highs for easy liquidity and then quickly reversed. And we're not talking about it in this video, but if you're more eagle-eyed, you'll see this low here. Once these candles close below that low, that's a market structure shift. Now, I'm not a big believer in market structure. I think liquidity is way more important, but some people do look at that. But what this is, this candle here, and you've got to understand, the overall thing. Because remember, we did all the hard work on the higher time frames. We know we're bearish. We know the key liquidity is at that key daily low, right? We're bearish and we're only looking for shorts, right? So we're operating on the lens of we're only looking for shorts. And this candle up here is just a fake little move. And I know you get a bit of a body. It's a fake move, but you got to wait for these candles. Once you're all the way down here, right? So you're on the charts and you see this right here. Clearly, you're bearish, right? Clearly, this was a fake move. And we strongly, aggressively moved down. We've got relative equal lows here. Nice and easy trade. And yeah, for your entry, you can either take the order block, which would be this candle here, which you just about get. Right, like this. Just about get. Like that. Stop loss always at liquidity sweep high. Like we keep saying, I'm going to keep saying this until you're all bloody profitable. Very unlikely that price is going to come up, take out this high again, and reverse, right? Now, it can happen. It does happen rarely, but that's why you have your stop loss, but it's very unlikely. And for take profit, you can target this low for an easy scalp. Easy scalp. Don't do anything crazy, right? Don't do anything crazy, but just target a 3-to-1. Now, usually, if you want to take the fair value gap, right here, yeah, your stop loss is going to be wider, and you wouldn't get a 3-to-1, I don't think. Right, in this case, and you wouldn't get this low either. But you can get a really easy high probability 2-to-1. Really easy high probability 2-to-1. And, personally, if you've done all the hard work, you've done all the analysis, I would just take the easiest entry. And fair value gaps often tend to be the easiest entry possible. But yeah, that is how you use liquidity to actually trade. You use it on the higher time frames, daily in the 4-hour, find the direction that market actually wants to go to. You go onto the lower time frames and you only trade in that direction. You wait for a liquidity sweep and then you enter on that direction. And yeah, I'm going to give you more examples until you guys understand this. Okay, so we're on euro dollar, and like we did in the last example, what we're going to do is we're going to look for the key liquidity pool, right? And in this direction, or in this trade, sorry, we've been bearish, huge aggressive moves on euro. We took out this low, this low, this low. All of these lows here had key liquidity at it. And at this point in the chart, so we're going to look for the most obvious key next liquidity pool. And if you look here, it's our next obvious liquidity pool, right? Lots of lows here on the daily chart on euro. There are billions and billions and billions worth of stop loss orders here. And the market will only move for those sort of orders, right? So we're bearish. We've got key obvious low we're going to go for. And we're going to look to short, right? Let me make this a bit more obvious. So we've got this key daily low. We're going to look to short, right? All these little opportunities we get at the lower time frames until price takes out this low. And once it takes out this low, it might consolidate like this, or it could even start to reverse, right? So we'll just wait for a few days. But as far as we're concerned, as long as this low is valid, we're just looking for shorts, and we just want to ride the higher time frame trend. And when we get in the lower time frames, we're only going to look for shorts, and we're going to wait for a liquidity sweep. Okay, so here we are on euro. We've got like key daily low. We've got London's low as well. So we've got lots of liquidity, and this key liquidity pool down here, right? And we're just looking for any reason to get short, And we're looking for our liquidity sweep. Now, right, this move right here is a fake move. It's a fake move. Now, why is it a fake move? Because we did all the work on the higher time frames, right? We know we're bearish. We know the direction of the market. This right here is a fake move, right? We're not looking to buy this fair value gap here. Although lots of traders who only know about fair value gap, they know nothing about liquidity. They don't do any higher time frame analysis. They're looking to buy price here, and they're hoping that price goes up and it comes straight down, takes out their stop loss, and then they're angry, right? But because we did all the hard work on the higher time frames, we're not looking for that. We're looking for short. We're looking for any reason to get short, and we're looking for a liquidity sweep. Now, this is a fake move up, and we get this high here, right? And we get these candles here that point above this high. That right there is your liquidity sweep, right? Price consolidates for a bit and then aggressively drops, right? And let me just make something clear. We only know that it's a liquidity sweep around here, right? Because price just came up, took out that high, and then quickly and aggressively and sharply shot the other direction. At this point here, once it wicks up there, I'm not thinking, oh, this is a liquidity sweep. I don't know, right, until it starts dropping aggressively, right? Because what we see here is just some consolidation here, and then once it aggressively drops down, then I know it's a liquidity sweep, right? I don't know it's a liquidity sweep until price actually shows me, until smart money actually show their hand that price wants to move down. And then again, we get fair value gaps and fair value gaps. So right here is your liquidity sweep. So let's mark this out. Right, so we've had our liquidity sweep like this, right? Aggressive move down, sharp aggressive move down. We've got a big fair value gap here. You've got an order block. The entry does not matter. And let me tell you something. The entry pattern is the least important thing. Right? If you've got the direction, right, like we've done on the higher time frames, you've got liquidity sweep. Entry pattern is the least important thing. Optimal trade entry, fair value gap, order blocks, breaker blocks, mitigation block, whatever you want to call it, whatever you want to use, all of them will work. So, in this channel, we just use the fair value gap because it's easy. You can use the order block, you can use any of it. So you put your stop loss right here, liquidity sweep. Like we always say, very, very, very unlikely that price come think about it, price come all the way down here. Right, very unlikely it's going to come all the way up, take out your stop loss, and then go straight back down, right? Especially when you're a day trader, because there's such a small time for price to actually move, right? So we've got a nice, safe stop loss. And what we're going to do is we're going to target the opposing liquidity, which is here, right? Easy liquidity right here. And you've got relative equal highs, right? So what risk to reward does that give us? Right, 2 to 1, or about 2.7. Just about get a free risk to reward ratio, but again, this is why I'm a big believer, and you don't target anything more than 3 to 1, because you might say, oh, well, it's all the way at this low. But okay, you get a 4.5 risk to reward ratio, but you've got to hold, for hours and through all the way up until Asia, really, which you don't want to be doing. Just take an easy, easy low-hanging fruit. 2 to 3 risk to reward ratio is all you need. With a 50% win rate, a liquidity sweep, higher time frame bias, you'll be fine. You'll be fine. And yeah, I'm going to give you another example. This time it's going to be in yen. Okay, so we're on dollar yen, and as always, we're on a daily chart, and you can do the exact same analysis on the 4-hour chart, but I'm just going to do it on a daily chart because it's nice and easy. And we've got this key high here, right? This key liquidity pool right here that price wants to go for. We're bullish. It's very obvious. We're respecting, these order blocks, these fair value gaps. It's all getting respected. Right? There's lots of liquidity at this high, and we know a price only goes for highs and lows. So all it does, it moves for highs and lows on the higher time frame. So we know we're bullish, we know we're targeting this key high, and when we get the lower time frames, we're only going to look for longs in dollar yen, and we're going to wait for a liquidity sweep, and then we're going to enter after a liquidity sweep. And it's really that easy. Okay, so we're running the 5 minute for dollar yen, and this is a London example, because I want to show you it works in all time frames, right? It works, in every market and all time frames. And right here is your liquidity sweep. So let's mark this out. Right here is your liquidity sweep, right? And like we said, it doesn't always have to be a wick, right? It doesn't always have to be a wick, because right here is our liquidity sweep, and you get these little candles. You see how price comes in, you get these little tiny candles right here, and the price quickly shoots off. This right here is what some people will call accumulation, right? I don't want to make this video too complicated, but what that really means is that price right here, and because it's at a dead time. Now, what do I mean by dead time? 1:30 a.m. New York time is, Asia's ended, but London hasn't quite begun. London begins around 2 a.m., right? 2 a.m., which is around here, is when London actually begins. And, 1 a.m., 1:30 a.m., because I'm in the UK, right? This is around like 6 a.m., 6:30 a.m. No one's really awake or trading at this time. So this is dead time. So price will wait, it will consolidate, it will accumulate orders, and then it will start moving during the actual session in London, right? This is Asia, and then you got London here, right? So this is why you get these little tiny candles. But this is your liquidity sweep, right? We had liquidity here. I remember we had this big move up. We're bullish on the higher time frames. And again, right here, this is another liquidity sweep, right? You see this low? See how it wicks down, instantly reverses. That's your liquidity sweep there. Right, that low, price comes down, wicks down, instantly reverses. That's the liquidity sweep. But in this case too, right, the only reason price came down here was just to take out this low and then quickly, sharply, aggressively moves in the other direction. That's it. That's the only reason it does that, right? So that's your liquidity sweep. And, it can be bodies, it can be wicks, but ideally it's about small little candles if it's a body, and then it quickly reverses. That's the key thing, right? If we don't see these aggressive fair value gaps in the opposite direction, then we're not bothered. But because we see this aggressive move in the other direction, we've got the higher time frame and bias, we've got all that in our favor. That makes it a liquidity sweep. And, in terms of entry, we're just going to take this fair value gap here. A nice, easy entry for you. So you're going to put your entry, this fair value gap here, stop loss at this low, because like we keep saying, if prices really come up, very unlikely it's going to come down, take out your stop loss, and then go straight back up. Very unlikely, because we waited for liquidity sweep. And the key thing is, you've got to have the patience to actually wait for a liquidity sweep, because if you don't wait for liquidity sweep, you're going to get swept. Price, you're going to do, you're going to get the bias absolutely right, like I used to all the time, but you're going to be impatient. You're not going to wait for liquidity sweep. Price is going to come down. You're going to be the one that actually got swept. It's going to go back up, give everyone else a chance to actually get in at a fair value gap here, and go straight to take profit. And you're going to be dead angry, and you're probably going to chase this move all the way up here. And as soon as you chase it, how many times has this happened? As soon as you buy it, like right here, it reverses like that. And you're blowing your account and stuff, And you always want to wait for liquidity sweep, because that will avoid all this hassle, man. Let's just remove all this, make the charts nice and clean. So in terms of take profit, you've got this key daily high right here. You've got key liquidity here. Let's target at least 2 to 1, and in this case, you get a free risk to reward ratio, just like that, right? If you really wanted to, you could target a 3.2, but it doesn't matter, right? I like a fixed risk to reward ratio. Because for me, I always target a 3-to-1. 3-to-1, nice and easy, high probability setup, done and dusted. And yeah, I'm gonna give you another example, this time in GBP USD. Okay, so we're on GBP USD, and I hope at this point it's starting to get familiar, right? It's starting to get familiar with what we're actually doing. We're on the higher time frames, and we always do this daily or the 4-hour. You can do the weekly, but you know, you can see the weekly chart on the daily chart, right? You know, this low here, you could also see it on the weekly chart, and this low too, right? So it doesn't really matter. I would say the daily or 4-hour, because the weekly is very slow, especially if you're a day trader or scalper. But nevertheless, for the daily chart, we've got this key low here, lots of liquidity here. We had, you know, another key low here that price took out, but this key low here, there's lots of liquidity here. And we know we're bearish. There's been no respect of this order block and no respect of this order block. So let's mark out this candle just in case you are unsure. The last down close candle here before the opening, that's your order block, right? Just make this a bit more obvious like that. That's your order block. Price comes in, aggressively, literally closes into the order block and wicks deep within it. There's been no respect of the order block, because if price actually respected the order block, it would have come in, tapped it, instantly reversed off. We don't get any of that. We don't get any of that at all. That right there tells you that we're bearish. We're bearish, and we've got this key liquidity pool, liquidity low, whatever you want to call it, right here. We know there's lots of stop loss orders, and we know we're bearish. So we're going to get the lower time frames, as always, wait for a liquidity sweep, and then we're going to wait for our entry. That's simple. Right, so we're on the 5-minute chart now, and we're looking for our liquidity sweep. I hope it's pretty obvious. We got this key high here. You know, you've also got this high here, these highs here, but let's just go for this high, right? It's pretty obvious. And let's just mark this out. This high here, lots of liquidity out here. So let's mark this out right here. And this is your liquidity sweep. This candle moves up, wicks through it, and then we get a bit of a body, and aggressively, sharply moves all the way down, taking out all this liquidity, and then leaves this daily low intact, right? Leaves the daily low intact. So this right here is your liquidity sweep, right? And you're going to wait for this. And this is in London. Sorry, this is in New York, right? The liquidity sweep. So let's mark this out. Liquidity sweep, like this, right? So this is your liquidity sweep. Fuck's sake, if I can actually spell. This is your liquidity sweep right here. Like that, right? Price aggressively moves down, and this is during New York, right? So New York, this is a New York news candle. So you often get this during news. A fake move up, because remember, on the higher time frame, we're bearish. We've done all the work on the higher time frames. We know where price actually wants to go. This is just a fake pump up during news. And we come up, we wick out, take out this high, quickly move down. And as always, because we're bearish, we've had our liquidity sweep, wait for price to move down, enter on the retracement, like that. That's what we always do. That's the highest probability trade. And yeah, in terms of entry, you've got a tiny little fair value gap here, but I know some of you really like order blocks. So order blocks in this case is just the last up close candle before the down move. And let me just tell you something about order blocks. If you've got an order block, that's also a liquidity sweep that we have here, and it has a fair value gap, like it does here. And I know we've got a lot of wicks, but if you've got an order block that has a liquidity sweep, has a fair value gap attached to it, that right there is a very, very high probability order block. And yeah, let's put my entry here, right? So we're going to enter at the order block right here, stop loss at the liquidity sweep high. And I'm going to keep saying this because people always ask me this. Very unlikely price is going to come all the way up, take you out, and go straight down, right? The market is not designed to, you know, take your stop loss out. It's designed to take out those with billions out, right? Not you personally, those with billions. So we're going to enter at this order block like that. So for take profit, we're going to target at least 2-to-1, or in this case, a nice, easy 2.3 risk to reward ratio. I know you get your 3-to-1 like that, but at most, you're going to be targeting a 3-to-1. Like that. Nice and easy. And this is how you actually trade with liquidity. You wait for liquidity on the higher time frame, so you wait for it to be obvious what daily high or what daily low we're going to go for. You only trade in that direction on lower time frames. You always wait for liquidity sweep, wait for a fair value gap, or any sort of entry, order block, optimal trade entry again. So for those who don't know, let me just mark this out very quickly. The optimal trade entry is you get your Fibonacci tool, because we're bearish, we do it from the high here all the way to the low. And me personally, I enter the 0.705 level. Right, you get in your Fibonacci settings like this. Like it. Pause the video. This right here is what you really need, 0.705 level. And yeah, take a screenshot of all these, because this is what I use personally. And yeah, for entry, enter right here. And the reason why I love the optimal trade entry so much is you don't have to think about what fair value gap, what order block do I take, right? It's so easy and obvious. And for me, I always target 3-to-1. Right, like that. Right? Like this. Nice, easy, high probability trade. And, you know, I do this on the 4-hour. Literally, this is exactly what I do on the 4-hour. I wait for a liquidity sweep, optimal trade entry, obvious liquidity. And because it's a 4-hour, this liquidity is always significant, and it's nice and easy. But when I was a day trader, it's the exact same thing I used to do. And Yeah, the entry pattern is the least important thing. As long as you've got the bias right, which you determine with liquidity, and you've got liquidity sweep, you'll be fine. You will be fine. And yeah, I'm gonna give you one last example because I really want you guys to get it. And if you're watching this far, you guys deserve a treat. I'm gonna give you in indices this time. Okay, so we're on US 30, Dow Jones, whatever, and this works on futures, by the way. A lot of people ask me, it works on futures, it works on CFDs, Forex. Works on stocks too, by the way. It works on crypto, works on all markets, because all markets only move for liquidity, right? All markets, crude oil, all of it all only moves for liquidity. And that's the only reason these markets move. And yeah, obviously, the bias is really easy on that, right? We're in a bull market, and we've got this key high here, this key high right here. And if we were bearish, this order block right here is the last up close candle for the down move. Price would have respected it, and by respect, I mean price would have literally just tapped at the wick and quickly moved down. And if you look here, it makes it more obvious. See how price touches it with a wick, comes down, kind of respects it. Now, that right there isn't respect, because you need to wait for a few more candles. But if price did do this, if price tapped at the wick and went like that, that right there would tell me that we're bearish. But because we're closing aggressively for it, there's no respect to the order block. That high right here, which is all-time highs, is very obvious for Dow. And yeah, we're going to get lower time frames, wait for liquidity sweep, and then we're going to enter. On a fair value gap or order block, doesn't really matter. Okay, so we're on the 5 minute for Dow, and we're just looking for any sort of liquidity sweep. And what's really important for indices, and this is so important, is that you don't really want to trade till 9:30, but 9:30 a.m. Eastern, so when the stock market actually opens, that is always a fake move. It's always a fake move. It's just there for liquidity sweep. Now, it doesn't look like a liquidity sweep in terms of, it's not like Forex where it's like a little. Let's just imagine we're bearish, where a little high gets taken out and it quickly reverses. It's not like that with Forex. With indices, what it tends to be, because we're bullish, is, so let's say we've been going up, and this is a 9:30 a.m. open, let's suppose. It's like a fake move, like a really aggressive fake move, and then price comes all the way up like that. And it usually retraces 10 to 11 a.m., continues up, takes out whatever key liquidity, let's say there's some key daily high, and then it'll start to reverse in the PM session, or it will just consolidate. That's what indices tend to do. And this fake move, this fake 9:30 a.m. move, is like a Judas swing, whatever you want to call it. It's a fake move designed to get retail traders going in the opposite direction. It generates liquidity. And that's how you trade indices, right? You always avoid the first 30 minutes. But what you can see right here is this fake move. Remember, we're bullish on the higher time frames. We've done all the hard work. We're operating under the lens like smart money is. We're only looking for any reason to get long. Right? We're not looking for any shorts. We're only looking to get long, right? And this move right here is a fake move. Around here, you've got some liquidity here. But like, if you look at the wicks, right, the wicks do the damage and the bodies tell the story. Now, what does that really mean? It means the wicks are usually stop runs. That's what they usually are. And this low right here, there's lots of liquidity, because if you look at it, this is like the end of London. You get this large move up, and you get your retracement. So let's mark this out. Right, like this. Like that. This right here is your liquidity sweep. Right, liquidity sweep. Let's mark this out. Liquidity sweep. We always wait for this. And for indices, you gotta very, very careful, because indices can be very aggressive during the 9:30 a.m. open. And for entries, because for indices, right, and this is so important, indices are best off traded on the 1 minute really for futures. But if you're going to trade it on the 5 minute chart, I've found is you don't really get a fair value gap. I know you get it here, but it kind of gets filled before 10 a.m. Eastern, and it's not really that good. For me, I'm a big believer in order blocks. I really like order blocks indices, because if you've got the higher time frame bias and you've got like a big strong order block, now that order block's quite high probability. And again, the order block's also a liquidity sweep, and it's got like a little fair value gap in. But this fair value gap's already filled by 10 a.m. So what you're going to do is you're going to enter on this order block. And let me just tell you something about order blocks really quickly. And this is a gem, right? As soon as price, and because we're bearish, so this the last down close candle for the up moves your order block. As soon as this body closes above that candle there, as soon as it closes above it, that right there makes it an order block, right? As soon as the body closes above it, that makes it an order block. Not the wicks, right? Remember, the bodies actually tell the story. The body is actually smart money, right? Not the wicks, but as soon as the body closes above that candle there, that's an order block. That's a valid order block. And you see here, the wicks here are only for the liquidity sweep. But what we're going to do, enter on the order block. We're going to enter at 10 a.m. Eastern, right, for indices, because we don't enter before then, because it's a fake move. Stop loss at this low, like we always say, very unlikely price going to come all the way down, take out liquidity sweep, especially for indices, which moves very fast, right? 10 to 11 a.m., the 9:30 till 10 a.m. is the fake move already, so it's very unlikely it's going to come down, take out your stop loss, go all the way up, give another retracement, and then go back up. Very, very unlikely that's going to happen. It can happen, which is why you always need your stop loss, but very unlikely. And yeah, for take profit, we're going to target at least 2 to 1, like that. or in this case, a 3-to-1. And down moves a lot, right? It moves quite a lot, so you can get a lot, and you can get quite a decent risk to reward ratio. Never more than the 3-to-1, like we always say. And I hope you can see now from all these examples. Whenever you aim for like a 4-to-1, you kind of almost get very close, and then price starts to reverse or just consolidate. A 3-to-1 is the best. That's for me. Me personally, a 3-to-1's the best. A 3-to-1 or a 2-to-1. Right? Those two are the absolute best, personally. And yeah, that is how you trade liquidity, right? That's how you actually use liquidity to make money in these markets. And out of all the things I've studied in technical analysis, liquidity is by far the most important thing. By far the most important thing. And if you follow me on Twitter, you can see I can read these markets like a book. Like, I'm not even joking. I can consistently predict where price can go, like non-stop, and it feels like a superpower. And the only reason I'm able to do that is because of liquidity on the higher time frames. And what actually makes me profitable is waiting for liquidity sweep and then entering. Because when I didn't wait for liquidity sweep, I'd always get the bias right. I would always lose, and it'd be so annoying. But to summarize, what you want to do is you want to get the daily chart or the 4-hour chart, and you want to look for key highs or key lows that price is going to go for. That is your liquidity, key liquidity pool. Then you're going to get into lower time frames. It can be the 5-minute, it can be the 15-minute, it can even be the 1 minute, and you're going to wait for a liquidity sweep. Once you get your liquidity sweep, you're going to wait for your entry, which could be an order block, fair value gap, optimal trade entry, or anything else you like. And you're going to aim for a 2 or 3 risk to reward ratio, nothing more, and ideally nothing less. And yeah, that's all you need to be a profitable trader. It's really all you need, and that's how you trade liquidity. So what is daily bias and why do we care? Daily bias is essentially the higher time frame direction. Now, why is that useful? These markets, all financial markets, doesn't matter whether you trade gold, forex, stocks, indices, crypto, they all move based on the higher time frames, which is the weekly, daily, and 4-hour. And that's because smart money, who essentially are large funds who have billions of dollars, they can only trade on the 4-hour, daily, and weekly chart, and they only look at these time frames. And what that means is that regardless of whatever time frame you're trading, the 5-minute, the 1-minute chart, is that the higher time frame trend will dictate where price actually wants to go. And the highest probability setups will always be in the higher time frame trend. And that's what we actually want to do with daily bias and top-down analysis. It's just to find where is the market actually moving towards? Where is it actually going to go? And to do that, there's 3 things that I always look for. Number 1 is liquidity. Number 2 is order blocks. And number 3 is fair value gaps. Now, what I'm really looking for is for order blocks and fair value gaps, I'm looking for them to be respected or disrespected. And for liquidity, I want it to be really obvious. So what does that really mean, right? Liquidity is the lifeblood of the markets. That means the only reason price actually moves is for liquidity. But in this case here, on the weekly chart, and I wouldn't recommend using the monthly chart. I'd use the weekly chart as like my highest time frame, then daily, then 4-hour. That will give you a higher time frame bias. And that's essentially top-down analysis. But on the weekly chart, we're on gold. And what I'm looking for is I'm looking for a key liquidity pool. And there's essentially 2, right? We've got one right up here and one right here, this low, right? The highs and lows to where price goes to. And, it's quite complicated here because there's a few things that could happen. The first thing is we continue up bullish and we go up like that. We make all-time highs and we take out this high. That's the first thing that could happen. Or number 2, what could happen is that price just starts dropping like this, right? Keeps going down and we get like a reversal, right? There's 2 things that could happen. And I don't know, right, based on liquidity, right? I can't just determine and guess where we're actually going to go. So what I do is I look at order blocks and fair value gaps, right? And what am I actually looking for? So let's study the weekly chart a bit more carefully. You see this fair value gap right here. So let me mark this out. So the gap between these 2 candles, this one and this one, is your fair value gap. Like that, right? You see how the weekly candles, remember, smart money and those who actually move the market are looking at the weekly chart. And they're looking a lot at this weekly candle. So this weekly candle, right, we're at all-time highs, we drop down, we wick into the fair value gap, and we instantly reverse. Look at that, we instantly reverse, and we get a huge bullish candle all the way up here. We instantly reverse, right? Now, to me, that's quite bullish. Now, why is that bullish? It's because we've respected the fair value gap, right? And by respect, what I actually mean is you see how the wicks just tapped it like that and then quickly shot off, literally like in a straight line up. That is respect. Now, disrespect for a fair value gap would look like this. Let's say the candle went all the way through and wicked through it. That would tell us that we're not really respecting the fair value gap. Now, why is that important? If we don't respect this fair value gap, right, if price starts wicking through it, and especially, this is for your notes, right, if the candlestick starts closing, so that the body actually starts closing through the fair value gap, that tells us that we're likely to be bearish because we're not respecting any bullish fair value gap. And if you look really carefully, right here, see this candle right here, this last down close candle before your move, this is the order block, and price doesn't even touch it. And I always say this, right? if price does not touch an order block and it just shoots off like that, right? Because what you would normally expect is for price to at least touch the order block and then quickly shoot off. But right here, price comes, it can only get to the fair value gap, right? So look at this, price can only get to the midpoint of this fair value gap and it quickly shoots off, right? That tells us that we're actually quite bullish on the higher time frames for gold. Right, we're quite bullish because price only touched the fair value gap and went off. But if we got a huge retracement like this, right, if you went all the way down deep into this order block here and then started to, slowly move up like that, that would tell us that we're not really bullish, right? We've got low probability conditions and we're likely just to come up into a premium so smart money can start to sell again, right? We don't get that. We don't get that at all. What we get is a sharp reversal, right? Price wicks into it, instantly reverses. Now, for me, on the weekly chart, that looks quite bullish, right? We're looking at this higher time frame trend. We're in a bull market. To me, that looks quite bullish. So let's get onto the daily chart and let's just see what we can see. And the thing is with the daily chart is we're just looking for confirmation. We're looking to confirm what we saw on the weekly chart because the higher the time frame, the more important it is. So make sure you remember that because the markets don't move for 5-minute liquidity or hourly liquidity or even an hourly order block, right? They move based on the higher time frames. And so the first thing I'm seeing, right, is this is the weekly fair value gap, right? The weekly fair value gap here. Price comes in, it literally gaps up here, shoots massively off. That right there is telling me that there's a strong bullish respect essentially because the fair value gap is acting as support in this case, right? And I talk about this all the time in the channel. There's another thing that I'm seeing right away. Let me make this a bit more obvious. This low here, right? This low here has lots of liquidity. And by liquidity, I just mean resting stop loss orders, right? Billions of dollars worth of stop loss orders are right here, right at this low, because everyone knows, let me just zoom out a bit, we've been on the bull market in gold. Remember support and resistance, you put your stop loss at the low and you buy. So people would have their stop loss here, moved it here, moved it here, moved it here, right? Everyone knows they trail the stop loss orders up. Someone would have done it here and they would have got swept out. Again, right? Right here, there's so much liquidity, and this wick here is your liquidity sweep. And we talk about this all the time on the channel, right? And I love to see this, right? This is what you want to see when you're actually bullish. So I'm going to mark this out, liquidity sweep. Now, what is a liquidity sweep? A liquidity sweep, right, is let's say when you're bullish, and we have a low, and we know there's lots of liquidity at this low. You see how price comes down, it wicks through it, just wicks through it, takes out that stop loss, and then quickly reverses. I mean, look how many daily candles we have here. 1, 2, 3, 4, 5. A whole week of strong, massive up-close candles, big, decisive candles, right after this wick came and took out the stop loss, right? And this is something so important. It took me a few years to realize this. The wicks, right, especially on the higher time frames, and even the lower time frames, are mainly stop runs. They're mainly stop runs. That's what it really is, right? So this wick here is just a stop run. The only reason price comes down here is to take out that low and then we quickly reverse. We quickly reverse. And what that does is because we know there's billions of dollars worth of stop loss orders there, smart money gets to take the other side of it, right? Because they need to buy. Right, if smart money wants to buy, remember they're buying with billions of dollars, not buying with $1,000. They're buying with billions of dollars. They need someone who's going to sell billions of dollars worth of gold. Now, we're in a bull market, so there's really no one selling billions of dollars worth of gold. But at the stop loss, their stop loss order, because they bought it, it's going to force them to sell it, right, to get it back. And that's going to allow smart money to buy it from them cheap, right? So ideally, these, this large fund, whoever's here, they don't want to, they don't want to get out of that position, right? They know long term we're bullish, but the way the markets are, it comes for their stop loss, takes them out. Smart money gets to, they're buying billions and billions and billions, and price quickly shoots up and it goes all the way up there, right? That right there is your liquidity sweep, and that's super, super bullish. Right, so what does that mean, right? So we know on the weekly we're bullish. We know on the daily we've had a liquidity sweep, and we've quickly shut off, right? The only thing I'm going to say now, you see this fair value gap here? Because a lot of people on Twitter were asking me this. They're asking me, are we bullish or are we bearish? Because they don't know. The reason is these candles here, right? Even though we're coming into a discount. Now, a discount is it's essentially a smart way of saying, buy cheap, right? Buy low, sell high. That's essentially what a discount is. It's just below the 50% level. But I don't want to talk too much about that. That's not that important. Right, but what a lot of people get wrong is, let's say we're in a bull market. They literally only want to see up-close candles, right? And people on Twitter ask me this all the time. This right here is just getting us into, essentially a discount, right? And the only reason we came down here was to take out, you see these lows here with the liquidity. That's the only reason why, right? We're at all-time highs. Nobody's selling gold. Smart money realizing we want to buy billions of dollars worth of gold where we can actually be able to get our orders filled here and here, right? That's the key liquidity pool. That's the only reason we came down. Like that, we've gone up. Here's your retracement, and then probably continue up, take out these highs here, right? Because lots of people, they think that in a bull market, price is just going to move like that, right? It's going to move straight up. There's going to be no down close candles for them, and that's just not how it works, right? Even if we're bullish, let's make this a bit more clearer. When we're bullish, what you're going to see, strong move up, no retracement, strong move up, maybe a liquidity sweep with this low, and then move up like that. Retracements like that, right? There's going to be down close candles. And what's happening is, in these down close bits here, in this down close here, where liquidity sweep is, people are starting to short, or they're panicking, they don't know what's going on because they're not looking at the higher time frame direction and analysis. So, even when it's a bull market, price will still drop to essentially allow smart money to buy cheap. Now, buy cheap, literally all it is, get the Fibonacci from a low to a high, and below the 50% level is essentially a way of smart money saying it's cheap to buy, right? And if you look here, literally look at the bodies, right? Because the bodies tell you the story. You see the bodies respecting the 50% level. They wick down a bit, and then they quickly shoot off, or at least they will shoot off, right? We're in live market conditions right now. So let's just remove this, and let's just study the daily chart a bit more clearer. So look at this gap here, right? Here's your fair value gap. Right here is your fair value gap. You see how price wicks into it? Well, at least it's about to start shooting off. I'm doing this in the live market, so I want you to know what it actually looks like live, right? So price should shoot up, right? And now we're going to get onto the 4-hour chart. So we know on the weekly chart, we're bullish. We've had respect of the fair value gap, liquidity sweep, respect of another fair value gap on the daily chart. And now on the 4-hour, the only reason we're really on the 4-hour chart is we just want to look for liquidity, right? We just want to look for liquidity. And again, look at this. Here's your liquidity sweep again. And I'm just going to literally just put the horizontal line here, right? Look at that. Price there's lots of lows here, right? There's lots of liquidity at this low here. Price wicks down, shoots right off, comes back down into an order block to allow us to continue up, right? And, I don't normally do this, but let's get onto the hourly chart really quickly. So we know we're bullish. We've had the higher time frame liquidity sweep here on the daily. We've had another liquidity sweep on the 4-hour chart. And then you get onto the 1-hour chart, right? Now the 1-hour chart, and this is important, the 1-hour chart is not a higher time frame, right? Smart money, they're not buying based on the 1-hour chart. They might execute their orders on the 1-hour chart, but all the analysis is done in the higher time frames. Let me just tell you something. This right here, because this wick here is the liquidity sweep. An optimal trade entry, which is my favorite entry pattern. This right here could be an easy entry for smart money, right? An easy entry, just like that on gold, like that, and then target a free tomorrow, like that. A nice and easy entry for them. And there's lots of entries we've done on the channel, but the thing you want to look for, the 1-hour chart in this case, is you see this order block here. Now, this little doji. Look at this little doji. I'm just going to merge these two candles together, and this is something for your nerds about order blocks, right? If you've got a massive doji candle with a tiny little body as an order block, just forget about it. Literally just forget about it, because the body of an order block is the most important thing by far, right? So this one right here, this massive body, that's what I'm going to consider to be the order block. If you look at it here, like that, that's the body of the order block. And again, look at the wicks, right? The wicks are stop runs, right? If you see a wick that just taps an order block or just taps a fair value gap and instantly shoots off, that right there is probably the most, the strongest, bullish sign that you can get. And bearish when you reverse it, right? That's such a strong sign. But the price only came down just to tap the order block. Now, why does it do that, right? A lot of smart money traders, I say, or hedge funds, they're essentially like algorithms, right? So it's coded that as soon as it hits this order block in a discount, which means it's below 50%, they just fire orders, bam, 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 right? So it shoots right off, right? So algorithmically, it's coded that this order block here, as soon as price hits it, bam, 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 they're going to start buying. Right, now what does that mean for you as a trader, right? We've done all the hard work on the higher time frames. I keep saying this, right? The hard work is on the higher time frames. And the good thing is, once you've got the bias, right, bias doesn't change every day. Right? Every day, like let's say you trade on Monday, you're not going to wake up on Tuesday and think, what's the bias, right? You've got the bias for at least a week, right? At least a week. And at this point here, you're just looking for any sort of entry pattern. And, we're not really going to talk about entry patterns, but my eyes just instantly see this fair value gap here. Right, another fair value gap. If you wanted to trade the hourly chart, right, there's your entry. Bam, it's the fair value gap. Now, what do we target? I always say this. What do we actually target? Liquidity. Now, where's the next liquidity pool? Remember, we're bullish. We've respected the fair value gap. We respected it again, right? And this is in live market conditions. Where's the next obvious strong liquidity? Where's it most likely to be? Like here. This is where it's most likely to be, because we know at key highs there's so much liquidity. Right? And price is probably going to come up to you, another retracement here, and bam, like that. Right, there'll be lots of entries on the 15-minute, 5-minute, any bullish fair value gap, any bullish order block will do after the liquidity sweep. And we're not going to talk about entries specifically in this video because it's going to take for ages, but literally all the other videos on my channel, they have a specific entry pattern that you can use. And the entry pattern I always recommend for beginners, let's say you're bullish, right? So you've got some sort of swing here. This low here is your liquidity sweep. So price comes down, takes out the low, shoots back off, right? Gives you a fair value gap entry here. and then you ride it up to, let's say this is the liquidity pool, right? Wait for a liquidity sweep, wait for a sharp move in the opposite direction, in the direction of your buyers, wait for a fair value gap to form, enter on the fair value gap, ride price up, aim for a 2 to 3 to 1. And there's loads of videos on the channel about that, but I'm going to give you another example. This time it's going to be on the dollar index, which is super important for Forex traders. Okay, so we're on the dollar index, and you might be asking, like, who cares about dollar index? We don't normally trade it, so why is it important? Let me tell you something. This is the most important market in all of trading. Right? It doesn't matter what you trade, stocks, indices, crypto, Forex, indices. I've already said indices, but it doesn't really matter, right? Whatever you trade, the dollar moves all markets. Now, why does it move all markets? This is the currency of the US, right? Which obviously it's the most powerful, it has the biggest economy, and it drives all financial markets, right? And especially Forex. If you trade Forex and you got the bias right in the dollar, well, you've essentially got the bias on the euro, GBP, AUD, dollar, yen. All you gotta do is for like the mates, let's say euro and GBP, is you just gotta reverse it on its head, right? So if we're bullish on dollar, that means we're gonna be bearish on euro, it means we're gonna be bearish on GBP, and it means we're gonna be bullish on dollar, yen, right? That's so important. So run the weekly chart. The first thing I'm looking for, I mean, it's a bit more obvious, it's the first thing I like to see is I like to see a liquidity sweep, right? I normally like to see a liquidity sweep and a sharp reversal. If you look at this, like, we've had such a strong, massive, bullish move on dollar, and this low here had lots of liquidity. So let me mark this out right there. So right here is your liquidity, and right here is your liquidity sweep. So let's make this a lot more clear. So liquidity sweep. You see here, right? And this is, see how price comes down, wicks through it. I know we get a tiny bit of a body closure, and someone was asking me about this. A liquidity sweep can include a body. Right? A body can close through it. It's fine as long as it's a tiny little body. It's all right. But what we're really looking for is we're looking for price to come down just to take out some stop loss orders and then sharply reverse, right? I'm sure you can agree we've had a huge aggressive move in the opposite direction. So right away, I do like to see that. The only thing I'll say, and this is quite important, right, is, you know, we've taken out a lot of liquidity. We had key liquidity here, and key liquidity at this high here, right? And we're on the weekly chart. And if we look really carefully, and this is very important because someone was asking me about this. So this right here is a big bearish fair value gap on the weekly chart, right? It's a massive fair value gap on the weekly chart. Now, usually a fair value gap will look like this, right? This would be your fair value gap. But you see this candle here. You see how we wick into the fair value gap, we respect it, and then we start reversing off. What that really means is that part of the fair value gap has been filled, right? This wick here filled part of the fair value gap. So what that really means is the remaining part of the fair value gap is this bit here. This is the remaining part of the fair value gap, right? This wick has already filled in part of the fair value gap. This means that this bit here, this bit that's remaining, this is what's remaining of the fair value gap. Now, why do we care? Now, a fair value gap sometimes acts as a drawn liquidity. Now, a drawn liquidity just means a drawn price. That's all it really means. Because this is a good selling area for smart money. And remember, we're bullish, right? So we've come up, we've taken out liquidity here, we've taken out liquidity here, we've taken out here, and we've tapped the fair value gap. Now, I don't normally like to see this, especially if you're bullish. Right here, price wicks into the fair value gap, instantly reverses, right? Wicks in, sharp, aggressive move down, and a massive down close candle, all the way down. Now, I don't normally like to see that if I'm bullish. I really don't like to see that. And another thing I'm looking at, see this fair value gap here, right? See this fair value gap right here. Price has respected this fair value gap too, right? And this is so important. People always ask me this all the time. What if price is respecting both bearish and bullish fair value gaps in all the bonds? What do you do then? You simply just wait for it to become a bit more obvious, right? Because on the weekly chart, and I'm telling you this as like an ICT chartered student, like, I'm not sure what dollar wants to do. For me, it looks like it's either going to consolidate or reverse, right? You know, because it's Thanksgiving, literally the day of Thanksgiving that I'm recording this. So, you know, it could consolidate until the end of the year and then clearly move in one direction. Now, what would that actually look like? All right, we've had a massive move up, lots of fair value gaps here that need to get filled. Price could do something like this, consolidate to the beginning of the year, and then bam, well, let's say like this, right? Could do that. That's one scenario that we could get. Another scenario we can get is price consolidates, like it's doing here, and then starts breaking down aggressively. Takes out this low, takes out that low, and yeah, who knows what happens after that? We go below 100. Two things that could happen. Now, I'm not sure, which means I'm going to wait, or at least I'm going to get to the lower time frames. I'm going to wait for it to be a bit more obvious. And nobody tells you this, but there are going to be days and even a week where you can't determine daily bias, right? Where it's, you know, it's a 50-50 gamble, and you don't want to trade that because that's a low probability trading condition where you often tend to lose. So, you know, you don't want to be trading any of those, right? Because that's going to be a low probability trading condition. If you're not sure, don't trade. And I always say this: if you don't know, don't trade, right? Like, I'm not trading any of the dollar pairs until it's a bit more obvious to me, right? I want it to be more clearer for me. So let's just remove it. Let's get onto the daily chart and see what we can see. So we've touched the fair value gap. We've moved down. Now, one thing I'm looking at here is, you see this low? So we've kind of wicked through it. Now we haven't instantly shot off. Now, is this a liquidity sweep? Just think, right? Pause the video. Is this a liquidity sweep or not? Right? We've touched the fair value gap up here. We've come down. We've taken out this low. Is it a liquidity sweep or not? Right? The answer is we don't know. Right? We don't know if it's a liquidity sweep or not because the candles haven't formed. Now, if price does that, right? If it goes straight up, we get like 3 bullish, massive bullish candles. That right there would be a liquidity sweep. We would look for a retracement and continue up, taking out that high. That's what we would look for. But right here, we're not sure, right? We're not sure. We have huge bearish candles. We're not sure, right? And that means we're going to wait for more information. We literally need to wait for more candles to print, because what could also happen is this could be a little doji candle and we get a few more candles, and we could even touch this order block. We don't know, right? So we're going to wait for a few more days, right? But remember, on the daily chart, we're going to wait for more candles to print because we're not sure. And if you're not sure, you don't trade. Right, so we're on the 4-hour chart, and this candle right here, the last down close candle fully up move, that's your order block, right? So I'm going to mark this out. This right here is your order block, right? Look how price comes in and it literally wicks below the order block. Let me make it a bit more obvious. It literally wicks below the order block, right? That is not bullish at all. Right? That's not bullish at all. Remember the last example? The last example when price came, touched the order block, quickly moved off, right? That's very bullish. But the fact that we've gone deep into the order block, right, and we've not even sharply moved up, we've got lots of little doji candles there. That tells us it's low probability. Right? That tells us it's low probability trading conditions, and we just literally want to wait, right? Sometimes the best trade is no trade. The best trade is no trade. The best trade is just to sit on your hands and wait. Sometimes you need to wait for more data, and this is a case, a live example where you need to wait for more data. And I'm just going to show you the euro dollar, because if we've been bullish on the dollar, so let me just clear all this. So let's go into the weekly chart again. If we've been, bullish on the dollar, what would you expect with the euro? Right, you'd expect it to be bearish, and if we're on the weekly chart, it's almost a mirror opposite. Right, you've got the euro drops massively, dollar moves up massively. Right, it's a mirror reflection of each other. This is why I say dollar is so important. And dollar strength, and this is where you notice, dollar strength will force the price of euro down. Right, it will force euro to go down. Same thing with GBP USD. Right, the dollar is king. Right, a strong euro, but a stronger dollar. Euro dollar is still going to move down. It's still going to move down. Now, it won't be as strong, but it's still going to move down. But in this case, we've got a weak euro and we've got a really strong dollar. That means it's going to drop massively like this, right? Right, again, and if we look at this candle here, right, see this candle here, it's a bit more obvious. This candle here is your order block, right? And the body here is the order block. So the only thing that really matters is the body. You see how price wicks into it, instantly starts moving off. That almost looks like it could be a reversal, right? Almost looks like it could be a reversal on euro, right? And combined with the fact that we've got kind of a consolidating dollar, we don't really know what's going to happen. It could be a reversal. Now, what does that really mean? Let's get onto the daily chart here. Get onto the daily chart, man. You look here, lots of liquidity at these equal highs. And again, we've got a bearish order block, completely disrespected as price comes through it. Very likely that the euro is going to do something like this. Come up, take out this high. And here's another thing that's really important. These gaps here, these volume imbalances will almost act like fair value gaps, right? It will almost magnetize price towards it, right? So what you can see, and what you're likely to see, is that price going to come up and start filling in all these gaps, right? The gaps being this bit here, right? So here is your volume imbalance. So price can come up, fill in these gaps, touch the order block, and then who knows what could happen. So point is, in this sort of market condition, you don't want to trade. You just want to wait a few more days for it to be obvious and clear. Daily buys should be so easy and obvious, right? Remember with gold, how obvious it was. And, you want it to be so clear and overwhelming. I'm going to give you another example, this time on the US 30, where it's so obvious and easy where price actually wants to go and what the daily buys actually is. Okay, so we're on Dow Jones, and this is a good example because we're at all-time highs. There's no liquidity that we want to target, but the first thing we want to do is we want to see, is price respecting bullish fair value gaps? Is it respecting bullish order blocks? And in this case, yeah, it's overwhelming. We've got a weekly fair value gap here. Price comes in, touches it, instantly reverses off, and it literally gaps up. Right? It literally gaps up. That's how bullish we are. So we always want to see, and we don't even touch this order block here. Right? Now I'm going to compare this to another example, which is the Nasdaq. So Nas 100 up. I'm going to show you what a lower probability market looks like. and you can use this just to avoid actually trading it. So the weekly chart for Nasdaq, it does look right. It does look still bullish. Right, it still looks bullish, but with the Dow Jones, it's a lot more aggressive, aggressively bullish. And you want to be a part of the strongest setups, right? Similarly, when you've got a strong dollar and you've got a strong GBP USD, and you've got like a weak euro dollar, you want to be shorting euro dollar, right? You want to be in the best setups, and the best setups will be the ones that are either the strongest and you're going long in, or the weakest and you're shorting. So let's get onto the daily chart for Dow, right? We can get onto the daily chart for Dow, and again, you see how we touched the fair value gap, instantly shoot off. Now let's get onto the daily chart for Nasdaq, right? I think that's a daily chart for Nasdaq. Right, if you look at it, look at all these candles here. All these little doji candles, not really anything, whereas with Dow Jones, we instantly shoot up, we gap up, we take out the high. That right there is SMT divergence. Now, I don't want to talk too much about that, but what you really want to do is you just want to look at the daily chart, and you can just see if you're bullish, which both of these indices are bullish, but the Dow Jones by far is the most bullish out of the two. And the reason we know that is you see this high here, the fact that we've taken it out, the fact that we've got nice, strong, big candles, whereas here, we still haven't taken it out. Right, that tells us that the Nasdaq, even though it's bullish, it's very lethargic, very slow, and there's going to be lots of trades, and you probably have had this all the time. And I used to trade in Nasdaq, this used to happen to me, where let's say your stop loss would be here, price would come out, take you out, and then maybe come out and then just consolidate for a bit, and then slowly move up like that, right? Whereas with Dow Jones, what you'll get with the Dow Jones is you'll get nice, big, strong moves, small retracement, big moves, small retracement, big moves like that, right? And that's what you want to be in. That's what you actually want to be in as a trader. And this is the whole point of doing higher time frame, top-down analysis, that you could actually look at the chart. And just by looking at the daily chart, we know we don't even want to trade Nasdaq. We don't even want to go long in it. We just want to go long and down. We just want to go long and down. And, you can get onto the 4-hour chart and make it a bit more obvious, right? Again, just like this. And again, we're respecting this order block right here. This order block right here is being respected, and I just want to quickly look at the S&P 500 just to show you the comparison between the two. Right, so we've got the S&P up around the daily chart. Now look at this, right? Look how we touch the order block. Here, see the wick? We touch the order block right there and the fair value gap, and then we shoot right off. And we've got this obvious liquidity dip, so we're about to go for. So we're literally about to go for all-time highs. So I'm recording this. And if you look at Nasdaq, here's Nasdaq. Small, little lethargic doji candles, large wicks that we don't want to be a part of. S&P, nice and strong. Dow Jones, really strong. So what does that actually mean as a trader? Right, you've done the top-down analysis, but look at the higher time frames. I mean, you don't want to trade Nasdaq, you want to be in Dow, and you can also trade the S&P. Right, you can also trade the S&P, you can also trade Dow, but you just avoid Nasdaq. And the exact same analysis that we've just done here applies to GBP, USD, and Euro Dollar. And it also applies to silver and gold. So let me really quickly show you this, right? Let's go down onto XAU USD. Alright, so here's gold. Like we said, we know we're bullish. We know all about it. We know we touched the fair value gap. Right, to continue going up. And then here's silver. Right? Here's silver. Silver, slow, lethargic, it's taking out this low. Not good to trade at all. Whereas gold, nice and strong. Nice and strong. You want to be in those sort of pairs. And let's get Euro Dollar and GBP USD up. So, right, if you look at Euro Dollar on the weekly chart, look at this low, right? Look at this low. 15th of April. See how we take out the low? Aggressively take out the low. Here's GBP USD, right? Look at that. Here's the exact same low, and we refuse to take it out. We refuse to take it out. Now, what does that mean? That means GBP USD is very bullish. The underlying strength of the pound, so GBP itself, is bullish, whereas with Euro Dollar, the euro itself is very weak. Right, now what does that actually mean as a trader? It means on lower time frames, you want to be shorting euro, and you want to be going long in the pound, right? The exact same way, let's look at the S&P. If you want to be going long in the S&P, and you want to be shorting Nasdaq. If you were bearish, you want to short Nasdaq, and you want to go long in the S&P, right? This is how you use top-down analysis and daily buys to actually be in the best setups, right? And that's the power of daily buys. Just by looking at the higher time frames, I already know on the 5-minute chart what I'm looking for and what I don't want to even be a part of, right? I know if I want to go long, I want to be in GBP USD. I know if I want to go short, let's say, I want to be in Euro Dollar. Right? I know just by looking at the daily chart, don't even bother looking at Nasdaq, right? Don't even go on the 5-minute chart. I know, look at the S&P, let's get on the 5-minute chart, target easy liquidity. Right, that is how you use daily buys. That's how you put it all together. Put it all together. You filter out the bad setups, and you only trade the absolute best A-star setups. Okay, so what are these 3 easy entry patterns? The first is a fair value gap, and this is probably the easiest and most simple entry pattern. It's an absolute moneymaker. It's such a good entry pattern, and A fair value gap, for those who don't know, is literally, see how we've got this candlestick's body here, right? You see how we have a wick here and a wick here. You see that gap? That gap is what a fair value gap is. That's all a fair value gap is. It's that simple. Now, why a fair value gap is important? Like, most people don't know this. They just pick a random fair value gap. The reason why a fair value gap is important is because it's telling us that price quickly had to move away. It quickly moved away. So let's just make this a bit more clear, right? You see how price quickly has to move away, comes up like that, right? This is why a fair value gap works, right? Because you see how there are no wicks covering this body, right? That means that price here, like this candlestick didn't have any time to go all the way up here and fill it up. Had no time to do that. That's because price is super bearish, right? And because it's bearish, a bearish fair value gap is formed. That tells us that smart money, this entity who actually move price for billions of dollars, that they're bearish, right? They're all looking for this sign. They're all looking for a fair value gap, right? Because this is a clue in price action, right? You know, there's so many indicators. Everyone's using a different indicator, but there's one thing that all traders are using. They're using candlestick charts, right? And they might add other stuff. They might use VWAP, they might use, level 2. But everyone's looking at candlestick charts, right? So everyone can see this fair value gap. That's why it's so important, right? So this fair value gap here is your entry, right? You enter on the retracement to a fair value gap. And it's such an easy, high probability setup, and it occurs all the time. And like I say, if you aim for a 2-to-1, you can easily make money. You can easily make money with a 50% win rate and a 2 risk reward ratio. Now, with a fair value gap and liquidity, which is the key concept, which we talk about in other videos. I'm not going to talk about in this video, which is liquidity is literally just targeting stop loss orders, right? Support and resistance, another flawed concept that does not work, which is why so many retail traders fail. If you just flip that on its head and you just target key support and resistance levels, because it's going to be stop loss orders, you will make money, right? At this level here, right? Price came all the way down, it left relative equal lows, so people would start buying here, and they'd put their stop loss orders, so it's more obvious, they put their stop loss orders around this level, thinking it's nice and easy. And the price comes up, and what does it do? Smashes right through it, and then instantly goes the other way. This right here is just a stop run. Price comes down, take out liquidity, and then quickly moves the other way. But anyway, we're talking about fair value gaps here, right? A fair value gap, literally just a gap between 3 candles. So you've got this candle here, and this candle here. The body, right? See how there are no wicks covering the body? That gap there is your fair value gap, right? It's as simple as that. That is what a fair value gap is. It's nice, easy. It's easy to spot on the candlestick chart. So you've got another one here, and it's such a great model, especially if you're like a scalper, right? Because right now we're on indices, and let me tell you something. This works on all markets, right? So people ask me about this. It works on all markets. It works on forex, indices, commodities, crypto, synthetic indices, right? People ask me about that, like the VIX and stuff. Even works in like the Turkish stock market. Someone was asking me about this, right? If you have candlestick charts, a fair value gap will work, and liquidity will work, right? All these concepts work. It applies in all markets. So, don't feel like pressure that if you trade like a unique market that it's not going to work, because trust me, it works on all markets, right? So a fair value gap, nice, easy model, and for me, I would say from like years of experience, a fair value gap's really good if you just want to be a scalper, right? Like right here, you want to quickly get in the move, quickly write it down. It's really good, right? Whereas for the other 2 entries, which are an order block and an optimal trade entry, you require a retracement that's a bit more deeper, right? So a bit more deeper like that, which is good for like day trading and swing trading. But if you just want to be a quick scalper, in and out, a fair value gap is a money maker. It's an absolute money maker. It literally gives you the bias, right? If you ever struggle, a big, strong fair value gap at key time of day, it's going to tell you where the market's going to go. Because this is a clue, right? Smart money, they can spoof orders on, level 2, all that sort of stuff. They can manipulate price, but what they can't manipulate is the candlesticks itself, right? Everyone can see this fair value gap, and that's why it's so powerful. So, yeah, that's the fair value gap, and in the next example, I'm going to show you what an order block is. Okay, so for our next example, we've got something called an order block. Now, an order block is simply, when you're bearish, it's the last up-close candle before a strong down move. That's all an order block is. It's not complicated. It's very simple, right? So you've got the last up-close candle before the down move. That candle here, this candle right here, is your order block, right? And I'm going to mark out the entire candlestick, right? This whole candlestick is an order block, technically, right? Technically, it's an order block. But with order blocks, the body of the candle is the most important part. So let's just remove the wick, focus on the body, right? This body here is the meat of the move, right? It's the meat of the move because the wicks do the damage and the bodies tell the story. The body is where the real money of the market is, right? The real money of the market. So you ever watch candlesticks print, right? Let's just make it more obvious. If you ever watch candlesticks print, for the majority of the time, it's just going back and forth, back and forth. It might quickly go up, go back down, right? Quickly go down and then go back up, right? The majority of the money is in this bit here, right? Imagine this bit. Let me just make this a bit more clearer, right? Imagine this almost consolidation bit is one candlestick. This bit here is the body, right? This is the body, and then this bit up here is the wick. This bit up here is the wick. So I hope that makes sense. Maybe that was a bit of a weird analogy, but that's what it is. This body here is where all the money is. It's where all the orders is. If you went on level 2 and all that, you would see that in the volume profile that this is where all the orders are. Right? You don't need any fancy gimmicks. You don't need Sierra charts or any of that. You just need to look at the candlestick itself. So this order block here, this body tells you everything that you need to know. Tells you everything you need to know, and it's a fantastic entry. Now, you can if you really wanted to, you can enter on the wick here, right? Which will look like this. You can enter on the wick, right? On the retracement note, on the wick, put a stop loss at the high, and then target a 2 or 3 to 1, right? Like that, which you do get around here, right? So it's fine. But for me personally, I always like the body of an order block, right? Because like I said, the body's got the real meat of the move. It's where smart money, this entity who actually move price, who have billions, they're looking at the body, right? The body of the order block is absolutely key. So if you went on the order block body like this, right, you get a nice tight stop loss. Now, someone was asking me about this. You don't put your stop loss at the body's high, right, for an order block. You never do that. You always put it at the candlestick's high of the order block itself, because like we said, price can, let me just make this clear, price can come and just wick out, right? It can wick up like that and then go back down. So if your stop loss is really tight here, so your stop loss is like that, you're going to just get stopped out before price goes in your direction. So if you put your stop loss right at the top of the candlestick, you'll be fine. And similarly, when you're bearish, when you're bullish, if you put it at the low of the candlestick, you'll be fine, right? So you enter on the body, and then you target 2 or 3 risk to reward ratio, like that. Lovely, simple, easy entry pattern. An order block is fantastic. Now, an order block, from my experience, it's not the best, when you're scalping and stuff, but it's good for day trading, right? I know we're on the 5-minute chart, but for indices, you can day trade on the 5-minute chart. But if you're on the 15-minute chart, the order block is very good. It's a very nice entry pattern. It's very nice, very reliable. And the body is the real meat of the move of the order block, right? But if you have let's say a doji candle, right? You've got a doji candle like this. It's got a tiny little body. Don't enter on the body like that, right? Don't just have your entry like that, 'cause that's too, it's too small of an entry. You always want to be realistic. So, this isn't an order block, by the way. This candlestick here is the order block, but we're just studying this doji. If you wanted to enter on it, you would do something like this, right? Stop loss high like that, right? And you just consider the whole wick, right? But, use a bit of common sense. If you've got a massive candle with a huge body, just take the body, right? Just take the body. But yeah, that's how you use order blocks. Really good, especially if you're in the trending market. Really good, really nice entry. And really simple, to be honest. And my last entry, which is my absolute favorite, is an optimal trade entry. And this literally is just a Fibonacci retracement. It's that simple. And I'm going to tell you a secret, right, about the optimal trade entry, which is so good. The reason why ICT, right, the guy who actually made it, the reason why it's so powerful is because it has an order block. And usually on the lower time frame, it'll have a fair value gap built into it. So you don't even need to look at the other two, right? So an optimal trade entry is, because we're bearish, put this high, this low, right? We put our Fibonacci from the swing high, this high, and the swing high is just the most obvious high. I don't go too much into the market structure. Just, use a bit of common sense. What's the most obvious high? It's here, low here, right? You're not going to use this high, you're just going to use this high here. So Fibonacci on the high, all the way to the low, and then you enter at the 0.705 level. So quickly get this up, right? Right, so here are the Fibonacci settings, pause the screen, take a screenshot, whatever you got to do. So 0.705. That's the golden zone, and from years of experience, that's the absolute best. In terms of getting actually into the entry and getting your orders filled, but getting a good risk reward ratio, that's the best, right? So we're gonna enter here, stop loss at the high, and then we're gonna target at least this low here, right? Never ever just target a 2 to 1 for the optimal trade entry, because there's liquidity right here, right? So just target this low for at least a 2.4, right? Because it's a Fibonacci. And because the distance is always the same, you're mathematically guaranteed to get a 2.39 risk to reward ratio. So you don't need to worry about, which fair value gap is it, which order block am I picking, is this even a valid order block? Optimal trade entry, probably the simplest, entry pattern in all of trading. And if you combine it with liquidity, you can be a profitable trader. And I'm not just lying when I say that, because that's literally all I do. All I do is this model on the 4-hour chart, targeting key highs and key lows. So yeah, and I always aim for 3 to 1 like this. I aim for 3 to 1. Nice, easy. You can make, trust me, you can make all the money in the world with this model. All the money in the world with this model. But what I would say for the optimal trade entry is, let's just clean the charts a bit. For the optimal trade entry, the higher the time frame, the more reliable this is. Because if you've got this on the 4-hour chart, it is a very safe bet. It's a very safe bet. But, let's just say, And this goes for all like PD arrays, right? So fair value gap, order block, optimal trade entry. The lower the time frame you go, the less reliable price action becomes. And this is why I'm a big believer that if you're like a new trader, you should start off as a swing trader, right? And you might not like that, but swing trading is so much easier than day trading, right? I think the failure rate for day trading is 80%, whereas for like swing trading it's like 50% or something. So, and that's just for traders in general. So make sure if you are struggling, let's say you're really struggling with day trading, if you move to the higher time frames, which could literally be the hourly chart or the 4-hour chart, your win rate will increase massively. But yeah, those are the 3 simplest, easiest entry models in all of trading. Now, you might think, is it that easy, right? Can I just use this entry pattern? To an extent, yes, right? But you need to have liquidity. Now, what is liquidity? Liquidity, like I said, is key highs and key lows, and usually on the higher time frames, right? So right here, we're bearish. And the reason we're bearish is we have these 2 lows here, right, where lots of people would put their stop loss orders. Let's just mark this out. Right, stop loss orders, which we call liquidity, right? Liquidity. This allows smart money who have billions in the market to actually get into the position. And again, let's just zoom out again. You've got key low here. Lots of people are buying at this low. They're buying at this low. They see price come up and they think that price is gonna. Let's make this a bit more clear. They think that price is gonna come down. Right, remember, we all learned about support and resistance. Price is going to come down, it's going to bounce off this level and move up, right? That's what a lot of retail traders are thinking, right? Now, we do the complete opposite of that, because that's what actually works, right? I spent literally a year on support and resistance, and like I had, when I say zero progress, like I almost had negative progress, because like I was traumatized by the markets. I could never, ever, ever predict where price was going to go. I had no idea what I was doing. And, I watched all those videos that said, support and resistance is it. Support and resistance is not it, and if you do the complete opposite of it, you'll be profitable and you'll probably get the direction right 90% of the time, because that is literally how I trade. But yeah, what you need is liquidity. As long as you've got liquidity, and the higher the time frame, the more important liquidity is, and you've got any of these entry patterns, you can be profitable. And the key thing is you pick one of them: fair value gap, order block, or optimal trade entry. That's all you need to master. But if you look here, we have a bullish fair value gap. Let's mark this out. We have a bullish fair value gap which fails. Now the reason it fails is because we're not targeting liquidity. Like we said, we're bearish, right? We're targeting this low. That's why this bullish fair value gap fails. And this is why someone was asking me this. Can I plot on TradingView like the fair value gap indicator? Yeah, you can, but it's going to give you the fair value gaps that don't work, right? And most traders, they see a fair value gap and they just buy it because they saw on a video. They don't understand the logic behind it, which is you need liquidity, you need a direction. But yeah, if you've got liquidity, all you need is one of these entry patterns. Master one of them, and you can be a millionaire. You can be a profitable trader. And being a profitable trader is not as hard as you think. As long as you've got the right education and you've got the right mindset, you can be a profitable trader. And so what are we actually looking for? There's 2 things we want to look for. The first is we want to get on the 4-hour chart and we want to look for a fair value gap. Right, this is so important. We want to look for a fair value gap and we want to see how price actually reacts, right? Because a lot of the time, you'll struggle with daily bias. You won't know whether we're bullish or bearish. And with this model, we're going to wait for confirmation. Right, we're going to look on the higher time frames for a fair value gap, and then we're going to wait on the lower time frame for confirmation. Now, what does that look like? Let's say this is the 5-minute chart, and we've got a 4-hour fair value gap. What we're hoping is that price comes down, it taps the fair value gap, instantly moves off, and then we can just buy, let's say, a retracement here, where another fair value gap forms on the 5-minute, and then we can just ride price up for a 2 or 3 easy risk to reward ratio. That's what we're really looking for. We want to see price touch the fair value gap, quickly move away, right? Because when price quickly moves away, that shows us that smart money is actually respecting the fair value gap. If we get something like this, let's remove this. If we get a huge retracement through the fair value gap like that, and price starts doing that, that's not bullish at all, and we don't want to be trading that, right? Because how many times have you bought a fair value gap, let's say on the higher time frames, and price just smashes right through your stop loss? Right? So what we really want to do is when we get on the lower time frames, is we want to look for confirmations. Okay, so we're on the 5-minute chart, and here's that 4-hour fair value gap, right? I've marked it out. Now we're waiting, and what we want to see is we want to see price tap a fair value gap, move up, leave a fair value gap somewhere here, and then enter on that fair value gap and ride price up. That's what we want to see, right? And if you look here, we're waiting for price to retrace, and this is in a key time of day, happens during London. Price taps the fair value gap. Let me make this a bit more obvious. Look at this wick, right? Look how we just wick into the fair value gap. This 4-hour fair value gap. We just wick into it. We instantly start reversing. That right there tells you that you're bullish, right? For those who don't understand daily bias and stuff, this is what you need to be looking at. We tap the 4-hour fair value gap and price instantly starts reversing. Now at this point, we're just looking for a bullish fair value gap to form. Right, we're in a key time of day. We're looking for a fair value gap to form, right? Looking for a bullish fair value gap because we respected this. And what we don't want to see, and this is so important, we don't want to see price, massively come into the fair value gap. like that, and then massively come in. We don't really want to see any of that. We want to see price literally just tap it and quickly move away, and then enter on the retracement and ride price up. Because this confirmation, right? Price touching the 4-hour fair value gap, moving off, and then we enter on that retracement. That's such a high probability because we're actually waiting for confirmation. We're waiting for confirmation. We're waiting for smart money, who's actually moving gold, who's actually moving the price to show us that we're on the right side of the market. So let's remove these little lines here. What we're waiting for is waiting for another fair value gap to form on the 5-minute chart. And there's none here. There's a nice fair value gap here. Right, this 4:05 a.m. candle here. Right, nice, juicy fair value gap. And we're just going to enter on this fair value gap, right, on the 5-minute chart. Right, for a nice, easy entry. So like this, enter on the fair value gap. Your stop loss, right, and this is really important. For me, because we've respected the 4-hour fair value gap and we've shut off, for me, I will put my stop loss at this candle here, right? The low of the candle that forms the fair value gap. You don't need to put, you can put your stop loss here if you want to be really safe, but, putting your stop loss there is also fine, right? It's also fine. Now, the reason it's fine is because we're in London, it's a key time of day, and prices respect the fair value gap, right? Prices come in, it's tapped the fair value gap, quickly moved off. We're looking for any sort of retracement to ride price up. And I always say this, right? If we are bullish, it's very unlikely that if price did this, came all the way up here, it's going to come all the way down, take out your stop loss, and then continue up, right? We know we're bullish. Very, very unlikely that's going to happen. Now, there is a possibility that this could happen, which is why we always have our stop loss. But, your stop loss being here is quite safe. And for take profit, you're going to aim for at least a 2-to-1 or a 3-to-1, right? A 3 risk to reward ratio at most. Now, I always say aim for at most a 3 risk to reward ratio because, like we have here, literally we tap a 3 risk to reward ratio and we start reversing in New York, right? And we'll probably continue on. But, you always want to take the easy, low-hanging fruit, easy, high probability setups, right? And I know there's some key liquidity here, but we don't take it. We leave relatively equal highs. And, you could have targeted that. You could have targeted it like this. But for me, always aim for 3-to-1 because, this happens a lot. If you aim for like a, let's say a 4 risk to reward ratio all the way up here, what will happen is you'll get right. You'll be absolutely right. Let me make this a bit more clear. You'll be absolutely right with the bias. Price will tap the fair value gap, come up. You'll enter on a nice retracement. It'll come almost all the way up to your take profit and then start coming like that. Tracing and then might continue off like that, right? Who wants to win a trade like that? Take the easy, low-hanging fruit risk to reward ratio. And yeah, if you can get a few trades like this a week, you'll be sorted. You'll be sorted. And I'm going to give you another example. This time it's going to be on dollar yen. Okay, so we're on dollar yen, and this is a really good example, right? We've got this big fair value gap here, right? This big fair value gap that we want to study. And I'm going to mark it out, right? And someone was asking me this in the comments section. The fair value gap usually is like this, right? It's the distance between it's the gap between this candle here and this candle here. But you see this wick? You see how this wick fills part of the fair value gap and then comes down? That right there means the fair value gap that's remaining is this. Right, this is the remaining fair value gap. Let me make this a bit bigger. This is what's left of the fair value gap that hasn't been filled. Right, and you see how we just come up, we fill it again, and then we start reversing. Right, the fair value gap, once this wick's come in, it's covered part of the fair value gap. So this isn't the fair value gap anymore. This is the fair value gap that we're actually interested in. So that's something for your notes. And what we really want to see, let's just suppose this was the 5-minute chart, and this was the 4-hour fair value gap. We tap the 4-hour fair value gap. We move down bearishly. We come up. There's a bearish fair value gap that we enter on, and then we just ride price down. We ride price down for a 2 or 3 risk to reward ratio. That's what we want to see. We want to see price tap it and quickly move away. We don't want to see, huge retracement upwards, We don't want to see any of that. We want to see it quickly and aggressively move away, right? When price quickly and aggressively moves away from a fair value gap or order block, that tells you that the bias is super strong. And then just look at this candle. Look at this huge, massive engulfing candle that we get. But yeah, we're going to get the 5-minute chart. We're going to refine our entry. Okay, so here we are on the 5-minute chart, and here's that 4-hour fair value gap. So price comes in, it consolidates to quite a bit. Now this right here, you'll often hear this being called accumulation stuff. I don't want to get too much into detail about that because it's not relevant. But what this really is just smart money accumulating their orders. They're just getting their sell positions in, and then they're waiting for price to drop, right? And here's your retracement. So we're inside the 4-hour fair value gap. I'm just going to remove it just to make it a bit more obvious, right? When the 4-hour fair value gap, right here is another fair value gap that forms on the 5-minute. We always wait for another fair value gap to form on the 5-minute because that shows us that we're on the actual right side of the market, right? That's smart money telling us that we're on the right side of the market. We're not just going to, as soon as it hits the 4-hour fair value gap, just sell and hope it comes out. We're not going to do that. We're waiting for confirmation here. So what's happened really is we've touched the 4-hour fair value gap. We've moved down. We're looking to enter on this fair value gap and then ride price down. That's what we're looking to do. And I'm just going to remove this. We've got that obvious 4-hour fair value gap right here. And that's what we want to enter on, just like this. And if you look really carefully, right, you're going to put your entry like this. You're going to put your stop loss here, right, at these highs here. And, you might be asking, oh, how come there's not a liquidity sweep? Yeah, okay, look, ideally, there would be like some sort of liquidity sweep, right? And the liquidity sweep would be, let's just say price came up and took out a high, and we'd enter like that. That would be a liquidity sweep, right? Well, this high here just takes out these highs here. And, there's a whole video we've done on the channel on liquidity masterclass, check that one out. But, you can't always get everything in trading, right? You can't always get everything in trading. And for me, hitting the 4-hour fair value gap, aggressively moving the opposite direction, that's what I want to see. That's what I want to see. And put your stop loss here, take profit, at least a 2-to-1, or an easy free risk to reward ratio in this case. And I know you're going to say, oh, I could have got a 4-to-1 in this case, or 5-to-1. I'm telling you, from years of experience in trading, a free risk to reward ratio is the best, right? A free risk to reward ratio is the best. It's what I use personally. Most profitable traders are either using a 2 or 3 risk to reward ratio. Very few people are consistently getting 4 or 5 risk to reward ratios, and if they are, they're going to have a tiny win rate, and you don't want this, because this strategy you can get a 50-60% win rate fairly easily with this. And yeah, this model works all the time. You wait for a 4-hour fair value gap, wait for price to enter it, wait for confirmation on the lower time frames, and then enter on that fair value gap. And I'm going to give you another example. This time it's going to be in Dow, and I'm going to make it on the 15-minute chart, because I want you to know that it can be on the 5-minute or the 15-minute chart. So yeah, I'll see you on the US 30. Okay, for the last example, run Dow Jones or US 30, and this is an interesting example because we've got a 4-hour fair value gap and price wicks below it. I'm going to talk more about this, but we've got a small fair value gap, and I want you to know how to actually trade this. So let's get onto the lower time frames, and we'll see what we can see. Okay, so we're on the 15-minute chart, and here's that 4-hour fair value gap, right? And you'll notice that price actually goes a bit below the fair value gap. It closes a bit below it. But, it quickly shoots off. And for me, because the fair value gap is so small, right, because it's so small, it is kind of reasonable that price would come down and then just tap this order block here, right? All these candles right here is an order block. And then look at this, right? Look at the aggressive move. This is the real move, right? The real aggressive move is upwards, right? Retracement, right price up. Typical, same old stuff, day in, day out, right? So we've got the 4-hour fair value gap. Price comes in, consolidates a bit. We touch the order blocks here, right? We touch the order block right here. All right, look at this wick. This wick's high. Let me mark this out, actually. The exact high of this wick. Price comes in. Look how beautiful that is, right? Look how much it respects it. The bodies tell the story. The wicks do damage, right? The bodies right here are closing on this order block. Smart money are buying. They're rapidly selling it. They're rapidly, firing their orders in. Buying, accumulation. And then bam, price massively moves up. It massively moves up, and we're just looking to enter on the retracement, right? We're looking to enter on the retracement. So let's just remove this, right? Let's remove the 4-hour fair value gap too. And we're just looking for any sort of fair value gap to form on the 15-minute chart, right? On the 15-minute chart here. So we've got this big fair value gap right here, right? So here's your fair value gap here. I remember, because we're on the 15-minute chart, we can be more of a day trader. We can hold for a lot longer, a lot larger moves. And for indices, personally, I like to day trade. I don't really like to scalp them. So what you're going to do, enter on that fair value gap, like this. Your stop loss is going to be, if you want it nice and safe, you can have it here. And if you're a day trader, you may as well just have it nice and safe, right? And you're just going to target at least 2-to-1, as always, or a 3-to-1, right? And look at that. Nice, easy, high probability setups. High probability setups. We touch the 4-hour fair value gap, we shoot off, we enter on the retracement, and we hit our take profit. Right? Consistent bread and butter setups. And what makes this setup so powerful, right? What makes it so powerful is we're actually waiting for confirmation. We're waiting for price to touch a 4-hour fair value gap, right? And the 4 hours is really significant because banks and smart money, they actually execute their orders on the 4 hour. That's what makes it really significant. So we're waiting for price to hit a 4-hour fair value gap, shoot off aggressively, leave another fair value gap, right? Like somewhere around here, and then enter on that retracement to the fair value gap and then ride price up. That's what we're really looking for, and that's why it's such a high probability setup. And yeah, it's really as simple as that. Wait for a 4-hour fair value gap. Wait for price to hit the fair value gap on the 5-minute chart. Wait for some displacement in the opposite direction. Wait for another fair value gap to form. Enter on that fair value gap. Target a 2 or 3 risk to reward ratio. That's simple. That's all you need to be a profitable trader. And what is an order block actually? An order block, when we're bearish, is the last up-close candle before a down move, right? The last up-close candle before a sharp, aggressive down move. And, right here we have 2 order blocks. You've got this one here, and you've got this one here. So, either one of them is valid, but for me personally, and for what smart money traders like to see, is you want to see an order block, and you want to see price quickly and aggressively move down, right? Quickly and aggressively move down. Whereas, for this order block up here, what you have is you have a bit of consolidation. Remember, on the 4-hour chart here, right? We're on the 4-hour chart. So we have a bit of a consolidation before we actually move down. Now, the best order blocks, and this is for your notes, have a sharp, aggressive move down. They quickly move down like we have here. A massive engulfing candle, and this is something also for your notes, when you've got a big fair value gap attached to an order block, that's a high probability order block. Very high probability order block. And what we're looking for really is we're going to mark out this 4-hour order block, right? And we used a 4-hour chart because this is the lowest time frame that smart money traders use, right? They execute on the 4-hour chart because, they've got, hundreds of millions of dollars actually put into the market. And when they trade, they actually move price. Right? They're actually going to move price. So they can't be on the 5-minute or even the 1-minute chart because, they're not even going to get their orders filled. And by orders filled, I mean, it's too much money, right? It's too much money for the 5-minute chart. So they're executing on the 4-hour chart. So they're looking at all this stuff, right? And, we don't have to trade the 4-hour chart. Although you can if you want, and you can be very profitable with that. But what we're going to look for is you see these wicks, right? You see how price comes in, it wicks, instantly reverses. Wicks again, instantly reverses. That right there is telling us that there's good respect of the order block, right? Because price quickly and aggressively moves away. That right there is telling us there's respect to the order block. Because what we want to see, and this is key for order blocks, right? We don't just randomly start selling as soon as price gets up to here. What we do is we wait for, let's say, price to come down like this on the lower time frames. Let's say this is the 4-hour order block. Wait for price to tap it, quickly move down, aggressively move down, telling us that we're also bearish on the lower time frames, right? We're not trying to guess. We're not trying to, sell as soon as we hit the order block. We want to see confirmation lower time frames, and that confirmation right there increases the probability massively. So you want to see price tap the order block like this, quickly move down, and on this price front here, it should leave an order block. So you want to see price come up. Let's say there's an order block around here, and then ride price down, right? So there should be some sort of order block at the top part of this price action like that, right? Like that. And we're going to enter on that order block and ride price down. That's what we want to see. We almost want a double order block confirmation. We want to see order blocks on the higher time frame, and then we want to see a lower time frames respecting it, right? And I'm going to get on the 5-minute chart, and I'm going to show you exactly what that looks like. Okay, so we're on the lower time frames, on the 5-minute chart, and here's that 4-hour order block, right? And what we want to see, I'm going to show you again. What we want to see price hit the order block, move down, ride price up to an order block, and then continue price down, right? We want to see confirmation. We want to see price quickly moving away. If we remove this, look, here's the 4-hour order block. We don't spend much time there, do we? We don't spend much time at all. We hit it with a few candles, we quickly move down, right? And this candle right here, this last up close candle for the down move. Now you can also consider this one, but for me, I just like this one personally. Now, why do I like this one personally? Can you see how we don't spend much time in the order block? This is the 4-hour order block. We have a few candles. We quickly, sharply, aggressively move away. That's telling us on the lower time frames we're also bearish. We have our confirmation. And that right there increases the win rate massively. Like, massively increases the win rate. At this point, we just want to look for an entry, right? We just want to look for an entry. Now, you've got an order block here and here, right? It's a bit iffy on which one you want to do. For me personally, whenever I see something like this, right? Because this candle right here, let's just suppose you're at your entry. Like this, right? Let's say this is your entry. You can have a really tiny, like 4-pip stop loss, right? And your take profit would be massive. I'm not really a big believer of that, and if you've watched a lot of videos on the channel, for me personally, I just want to get into the trades, right? We've done all the hard work on the higher time frames. We've got the confirmation. We just want to get into the trade. So for me personally, I would have my entry at this order block here. Now this is really important. Like, pay attention to this. The wicks of an order block aren't anywhere near as important as the body of an order block. Now what does that mean, right? The body of the order block here is smart money. Right, smart money are the bodies of the candle. The wicks do the damage, but the bodies tell the story. Right, the body is the meat of the move. It's where all the real orders of smart money actually are. The wicks are just retail, right? This is all retail stuff. The body is where smart money actually is, right? And the good thing about the bodies is, regardless of the broker you're on, regardless of spread, the body's going to be the exact same. The wicks will always be different. So for me, I like to enter at the body of an order block, right? I like to enter at this body of an order block, and my stop loss would be at this high, right? I always say, you always want to have your stop loss at a swing high for an order block. Don't just put your stop loss right there at the order block like that, right? You don't need a tiny stop loss, right? Because if you've done the right analysis, you can have a wider stop loss. You can have a wider stop loss. You don't need a ridiculous risk to reward ratio. I always say this, just aim for a 2 or 3 risk to reward ratio, right? But a nice, easy, high probability set. Yeah, when you got 3 risk to reward ratio. I know if you get a 4 risk to reward ratio if you really try and beyond, but most times pricing reverse against you, and you might have missed this trade. I'm going to show you because there's a few examples here, right? You might have missed this trade, right? And price quickly moves down again. Here's your second entry, right? Here's your second entry in London, right? This is a key time of day. So the first one's early London. The second one is around 3 a.m., like golden time in London, right? So this would be your entry, right? And this is quite a good example. You see this candle, right? You see how it's got large wicks on it? We don't really want to pay attention to the wicks, right? We don't really want to use that because if we do, we're going to have, a massive entry. We don't really want that. What we want is the body, right? The body's the real meat of the move. And for our stop loss, it always has to be at the swing high, right? For an order block. Don't try and finesse it. Don't ever put it at like the body, right? Because like I said, the wicks are like retail, right? The wicks are like stop loss. So you don't want to have a really tight stop loss, right? Have it nice and wide like this. So right here is a decent, safe stop loss. And then you're going to target at least a 2-to-1. Or for me, and I always say this, at most a 3 risk to reward ratio, right? If you really go on to a 4 risk to reward ratio, you just miss it, right? Again, this is why I'm not a big believer in targeting a 4-to-1. A 3-to-1 is absolutely fine. It's what I use personally. And again, let's say you missed this trade, right? For whatever reason, you missed the setup again. Again, you've got an aggressive move down. And we always want to see this from an order block. Aggressive move down, lots of fair value gaps. That right there is a real high probability order block. Real high probability order block. And another thing, this is absolutely key and something that I've missed out recently. An order block that forms inside a kill zone is super high probability. Alright, so write that down again. An order block that forms within a kill zone is super high probability. So this right here, this is before London, right? This is, Asia's ended, but London hasn't started yet. That's not really a high probability order block. This one's high probability. This one's really high probability, right? I mean, look at it. We tap it, drop massively, and then look at this one. Price comes in, comes to the order block again, and then massively drops down. It massively drops down because these formed in London. So these are London order blocks. Absolutely key. And yeah, so let's say you wanted to enter on this order block, right? Prices come down, you want confirmation, you've got your confirmation. This is the 4-hour order block. What you're going to do, enter on the body of the order block like this, right? Like that. Put your stop loss at this swing high here, right? Absolutely fine. And then target a 2-to-1 minimum or a 3 risk to reward ratio, which you just get. Again, you don't get a 4 risk to reward ratio, which is what I always say to avoid it. But that right there is an easy, high probability setup, and it's what smart money traders do. Day in, day out, and this happens all the time. And it's very similar to the fair value gap video I did, where in the 4-hour chart you look for a fair value gap, you look for confirmation in lower time frames. In this case, we're looking for order block. So you get on the 4-hour chart, wait for price to hit an order block, and then wait for confirmation. The fact that you wait for confirmation is what actually adds to the model and gives it probability. Because some people, this is a bearish order block. What they would do is they would just start selling randomly as soon as price hits it. They would come all the way up, take out their stop loss, and come back down, right? You don't want to do that. What you want, right? Because what we want to see, we want to see price come up, hit the order block, aggressively move down, clearly show us that we're bearish. Clearly, no doubts, 100% sure, or at least that, as accurate and as confident you can be in trading, that we're bearish. And then you want to sell price once it gets to an order block and write it down. That's simple. It's all you need to be profitable. I'm going to give you another example. This time it's going to be in euro. Okay, so we're on euro dollar, and what we're looking for here is we actually have a gap, and it's really important, this, right? We have a gap, so we don't really have any candlesticks itself, but a gap, especially a bullish gap or a bearish gap, is such a strong signal that price wants to move in that direction, right? A bullish gap is such a strong signal that we're bullish, right? We're aggressively bullish. There was no candles. That price was so aggressive, it had to move up, right? And what we're looking for is we're looking for the last down close candle before this up move, before this gap, before we start pushing all the way up here, right? Because the real up move is essentially this, right? All the way up to here. We have a little retracement into this order block, and then we ride price up, right? What we're looking for usually, and what we like to see is the last down close candle before the up move. Now, this little doji candle, let's make it a bit bigger. This little doji candle is essentially nothing, right? You want an order block that's actually got some meat to the move, right? You want an order block that's got a decent body, right? The larger wicks, you don't really want to pay attention to them. So for me, you've got this order block here. So I would just ignore this doji, right? This doji, because it's literally contained within this order block here. So for me, I would consider this to be our order block, right? This candle here. The whole lot makes sense, right? You don't want a little nothing candle, right? Like this candle here, again, a doji. You don't really want to pay attention, and you want a candle that's actually got some meat to the move. So this right here is our order block, like that, right? And again, you can probably tell what the lower time frame is going to look like. Look how price taps it, quickly moves off. And this is the 4-hour chart. So price taps it, quickly moves off. Now, what we want to see, as always, on the lower time frame, because this is the bullish case, price to come in to the 4-hour order block, massively move up, clearly showing us on the 5-minute chart that we're bullish, and then retrace down to the order block. We buy at this order block, we ride price up for a 2 or 3 risk to reward ratio. That's what we want to see, and that's what I'm going to show you on the 5-minute chart. Okay, here we are on the 5-minute on euro, and you see this. See how price wicks in, instantly moves off, and yeah, you do get a big retracement. And the reason for this, if you're interested, right, why we have such a large retracement on euro is because on the higher time frames, on the daily and weekly, we're actually more bearish on euro than we are on, let's say, GBP USD. But if you want to know more about that, make sure you watch the video on daily bias, right? The video I did on daily bias about 2 videos ago now. That's such a key video that will explain it. But what we have is we have price aggressively moves up. Again, you've got a fair value gap, which we always like to see for an order block. And this right here is your order block, right? This candle right here, the last down close candle before your up move, is your order block. Price shoots off aggressively, retraces. Now the retracement's deeper than we expected, and the reason for that is just because we're more bearish than we are in other currencies. But nevertheless, this is still good enough for us to enter. So what do? This body right here is our entry. We don't really like the wicks. We always enter at the body like this, right? This is going to be our entry. Now our stop loss, it's never just at the order block, right? It's never just like that at the order block. It's always at the swing low, right? It's always at the swing low like this, right? Like that, right? We always want to be trading like that, right? We want to see price come down like this. Well, stop loss always there, nice and safe, right? Nice and wide stop loss. If you've got the higher time frame analysis, right, like we've done, you don't need a really super tight stop loss. And this is why these people, aim like a 5, 6, 10 risk to reward ratio are always struggling and always unprofitable because their win rate's tiny. But for this is this is a high probability setup that occurs consistently. You probably get one setup a day in the majors. Yeah, what we're gonna do now? We've got our entry, we've got our stop loss there. We suffer a bit of retracement, right? Absolutely fine, normal for trading, right? I'm not going to show not every example. It's going to tap your entry, quickly move off to a free risk to reward ratio. That's not what every example is going to be like, or at least every live trade that you do. Right, for our take profit, we're going to target a 2-to-1 or a 3-to-1 like this, right? Nice, easy, high probability setup. And you see, look, if we target a 4-to-1, we target all the way up here for 4-to-1. Look at that, price comes up 3% and then just consolidates. Right, this is why I always say, target a 2 or 3 risk to reward ratio. Nice, easy, high probability, consistent setups, right? So all you need to be a profitable trader. All you need. Literally, if you can get 2 of these setups a week, like you will be fine. You'll be fine, Dad. Right, for the last example, I'm going to show you on indices, and I'm going to show you on the 15-minute chart because this exact same analysis that we've done on the 5-minute chart applies to the 15-minute chart and even the 30-minute chart, and even the hourly, like if you really wanted to go onto the hourly chart. But I'm going to show you it for day trading and scalping. And yeah, for the last example, I'm going to show you on the 15-minute chart. Okay, so we're on indices, right? And right here is your order block. The last down close candle for the up move, right? With this aggressive up move, lots of bullish candles, and here's something else for you notes. As soon as the candle here closes above this high, that makes it an order block, right? As soon as the body closes above the high, that makes it an order block. That's what actually makes it an order block. And yeah, for our entry, what we really want to see is you want to see price respect this order block like that. And if you just look at it, a bit more. If you just look at the 4-hour chart, look at the bodies respecting. Yeah, we get a tiny bit of it, but look at the bodies. We wick in, we aggressively move off. We aggressively move off actually to all-time highs. And yeah, I'm going to show you this on the 15-minute chart and how you can actually trade it. Okay, so here we are on the 15-minute chart, right? And this is the 4-hour bullish order block, right? So we're expecting what we're really expecting, or what we want to see in the lower time frames. We want to see price come in, move up, move down to the order block around here, ride price up. That's what we want to see, right? And we're on the 15-minute chart here. So everything on the 15-minute chart is a lot more significant than the 5-minute chart, especially for indices. And yeah, this example is very interesting, right? Because I'm going to show you another one later on, just around here. But what we have here, price hits the order block, right? During the indices AM session, reverses, entry here. Right? So your entry is going to be at this order block here, or it can be this one here. But it's essentially the same candle, right? You're going to enter at the body like this. You're going to enter the body like this. Your stop loss should be at the wick, right? But this wick is massive, right? It's absolutely massive wick. And this is something for your notes. If you ever see a huge wick like this, a massive wick, and rather than having your stop loss all the way down here, what you can do is you can get the Fibonacci on the wick low to the wick high, right? Like that. You see the 0.5 level, right? So this 0.5 level. Very, very unlikely, and in my experience, almost never, unless you're completely wrong, but almost never does price come all the way down here past the wick. Not take out your stop loss and go all the way out, right? Now, if it takes out your stop loss, that's absolutely fine, because either way you would have lost. So what I'm really saying, right, is that you can put your stop loss at the 50% level of the wick, and you can be pretty confident that price isn't going to hit it. So let's remove the Fibonacci. So right here, your stop loss is at the 50% level this way. Very unlikely that price will come and tap it. And you look, it doesn't even get halfway towards your stop loss. And if a take profit, as always, we're going to target 2-to-1 or 3-to-1. And now this is pretty interesting, right? Because we enter around 3:30 p.m. for indices. Now 3:30 p.m. indices is the last hour, which means if you're going to hold on to your position, you're probably going to have to hold on through Asia and London like you do here, because indices only really move during the New York Open, during the actual indices open, which is 9:30 to 4 p.m. Eastern. But this is why I want to show you the next example here, right? So let's just remove this. So this could be your trade. And if you get a 2 risk to reward ratio, nice and easy. If you want a 3 risk to reward ratio, you're going to have to hold on into like early London, essentially. But let's remove this. this 4-hour order block, right? This is for your notes. A higher time frame order block, which is a 4-hour daily or weekly, it can be returned to multiple times, right? So you see how we've returned to it. Well, sorry, this is the first time. See how we've touched it the first time, right? Retracement to the order block moved off aggressively, right? Again, look at this, right? Look how the wicks beautifully respect the order block. They literally tap it twice, massively aggressively moves off. Now, why is it massively aggressively move off? This is Asia, right? And I'd only recommend trading indices during the actual indices open. Don't trade it during London and Asia, but right here, we tap the order block, aggressively move off. That right there is telling you you're super bullish. And again, if you look really carefully, this is your retracement. So you know how I always say, I like to see us respect the order block, aggressively move off, retrace down here. That right there would be your entry during London. Now, we don't really want to trade indices during London because this is exactly why, right? Look at this. You know, it doesn't really move until the New York Open, right, around 9:30 a.m. So what I'm really saying is that this could be your entry here. This order block right here could be entry. I'm just going to remove the 4-hour order block, and I put this essentially zone right at the body high, right? Because we wouldn't enter at the body's high. And yeah, you do suffer some retracement, right? You do suffer some retracement, which is normal, especially during that indices open, right? Around 9:30, because 9:30 a.m. indices open, even when you're bullish, it's always a massive fake move like that. Price comes up, gives you a retracement like that. That's what usually happens during an indices session. But yeah, what you're going to do, you're going to enter on the order block like this. Your stop loss is going to be at the low. Right, it's going to be at this low here. And then you're going to target. So it's a bit more, but you're going to target at least a 2-to-1 or a 3-to-1 like this. Nice, easy, high probability setup. And yeah, of course, you suffer a bit of retracement. Now, the reason you suffer a bit of retracement is because you enter around 8:30 a.m., which is fine. But, you know, at 9:30 a.m. is when the real move will happen. And look at this. As soon as it's 9:30, quickly go to your take profit. And yeah, that's how you trade order blocks. What you want to see, to summarize, what you want to see on the 4-hour chart, you want to see price hit the order block, right? Hit the order block, and then you want to get on the lower time frames, and you want to see how price actually reacts. You want to see price on lower time frames. Let's say when you're bullish, you want to see it hit a bullish order block like this. Quickly, aggressively move off. Quickly, aggressively move off. Ideally, there'll be lots of fair value gaps in this price swing here. Then you want to see price retrace slowly towards your entry around here. And then you want to enter on an order block, which should be around this point here. You want to ride price up for a 2 or 3 risk to reward ratio. So your entry would look like this, right? Like that. Your stop loss would be at this swing low, target 2-to-1 or 3-to-1, like that, right? And there'd be some sort of order block, right? Some sort of order block here that you'd be entering on the lower time frames. This could be the 5-minute or 15-minute chart. And this move here, let's say, all came off a bigger 4-hour order block like that. Right, here's your 4-hour order block. We tapped it, moved off. We formed another order block on the 5-minute or 15-minute chart. You enter on that lower time frame order block. You ride price up. This is a high probability order block trading strategy, and probably the highest probability you can get for order blocks, right? Because we've got double confirmation. We've got the highest time frames, and we've got the lower time frames both working for us. But yeah, it's a great model. It works on all markets. It works on forex, indices, gold, crypto, all of that sort of stuff. Okay, so we're in the monthly chart, and the key thing with the monthly chart is that you only look at the most recent candlesticks, right? You don't look at any of this down here, right? Because every single candlestick is 1 month. So we're not looking at, 2023's price action, whereas, let's say this was the 5-minute chart, you'd be looking at this fair value gap as a possible entry, or even these order blocks. But on the monthly chart, we don't care. All we care about is the most recent candlesticks, right? The last few candlesticks. And if you look at this, right, for a big fair value gap here, a big bullish fair value gap, and what happens? What happens right here, right? Got a big bullish fair value gap. We're on gold. We know we're at all-time highs. Lots of people think that we're going to reverse, or at least trying to predict a reversal. Look at this, right? Price drops into the fair value gap, and it instantly wicks away. Instantly wicks away. We have this sharp, aggressive wick upwards. That right there is very bullish, right? It's showing us that price is respecting the fair value gap, right? And because it's a wick, that's even more important. Because let's just say we had a body, right? The body of the candle was closing like deep within the fair value gap. That would be quite a lot of disrespect for it. But because we have a wick that just caps the fair value gap, instantly reverses, that right there is super bullish. If we had, let's say we had the bodies closing deep within the fair value gap, that right there would not be bullish at all. Right? The wicks do the damage and the bodies tell the story. The reality is, this wick, right, this, price coming down here into this fair value gap, this was just allowing smart money to actually buy. They're just buying right here, right in this fair value gap. They're just firing their orders, right? Remember, we're on the monthly chart. The only people who are actually looking at the monthly chart are smart money, right? Smart money and smart money traders. Retail traders aren't looking at the monthly chart. Smart money is, right? So as soon as it hits this fair value gap, they're buying, buying, buying. And that's why you get this sharp, aggressive wick all the way upwards, right? And That right there on the monthly chart tells us that we're bullish. It tells us that the higher time frame order flow, which just means the higher time frame direction, is still bullish, right? It's still bullish. If price, like I said, if the body was closing in this fair value gap, or if the body actually closed through this fair value gap, then we would likely to be bearish, right? We'd likely to have a retracement, continue down. But because we've just had a wick like this, we instantly shot up, that right there is quite bullish. And the key thing with the monthly chart is it sets the overall direction of the market, right? The overall direction of the market is determined by the monthly and the weekly chart, because this is what smart money is actually looking at. That's what they're looking at. So we know on the monthly chart, the highest time frame you really want to use, that price is bullish for gold. It's bullish for gold, so we're going to get on the weekly chart, and we're now going to refine it, and we're going to see what we can see on the weekly chart. Because ideally, what we want to see is we want to see order blocks, bullish order blocks, and bullish fair value gaps being respected, right? We want to see price tap a bullish fair value gap and quickly move off, right? We want to see the weekly chart also confirm to us that we are bullish. Okay, so here we are on the weekly chart, right? We've had this huge aggressive move up, retracement, and, we've got a bit of consolidation, which is normal for December, right? Let me just make this very clear, right? So as I'm recording this, it's the 3rd of December, and what you usually see in December to mid-January is you'll see price just consolidate a bit all the way up until around mid-January, so like around January, like 15th, 16th. What you'll see is, let's say we're bullish, right? You'll see price come down, take out all these stop loss orders here, then quickly move up and then continue, right? It's normal for December to January to be quite choppy, so don't be alarmed by all these candlesticks. Just look at all this price action. Strong, clean moves. December, January, like, there's a bit of consolidation, stop run, and then we quickly move off, right? That's what normally happens. But run the weekly chart at it, right? We know we're bullish on the monthly chart, and we just want to see essentially the same thing, right? We want to see confirmation on the weekly chart, because the monthly and weekly chart, those are your two super higher time frames that will actually move price, because there's so much money behind the monthly and weekly, right? There's real money. There's billions and billions and billions of moving gold on the monthly and weekly chart. And if you look at this fair value gap here, so when it's been more obvious, right? You remember on the monthly chart we had that big fair value gap, right? We had a huge fair value gap that price went into. Here it's a lot more refined. So we've got a little fair value gap here, and look at that again, right? Price taps it with a wick, instantly shoots up. Look at that. I mean, look at how strong and aggressive that bullish candle was. Right? You almost can't get more, a more bullish candle than that. I mean, that's huge, a huge range. It taps the fair value gap, instantly reverses, massively reverses. That right there is showing us that we're still bullish, right? Showing us that we're still bullish, because with the monthly chart there is a time lag, because every candlestick's a month. It's obviously 1 month, but with the weekly chart, look at this, right? Price comes in, instantly reverses up, and obviously we're going to get a bit of a retracement, maybe a bit of consolidation because it's December to January, and then move off like that, right? But let me just say this: if price came down, smashed through the fair value gap, and got below these lows, these order blocks here, that right there would likely mean that we're bearish. But we don't have that. We don't have that, and this is what you want to do on the monthly and weekly and these higher time frames: is you want to see order blocks and fair value gaps getting respected, right? And if bullish order blocks and bullish fair value gaps are getting respected, like we have here, that tells us that we're bullish. And another thing that I like, and I think I've talked about this in a different video, in the order block video, is let's just remove the fair value gap. You see this order block here? The last down close candle before the up move is your order block, right? So let's just mark it out like this. You see how price, let's make this a bit more clear. You see how price doesn't touch the order block? See how there's like that little gap there? Right, price comes in, doesn't even touch the order block, and then quickly moves off. Right, and we talked about this in, I think, the order block video. This is so important because this tells us that price couldn't even tap the order block. It could not even hit the order block. And that right there tells us that we're so bullish. Or we're so bullish that price could not even tap the order block. Because what normally tends to happen is that price will come in, tap the order block, and then quickly move off. But we're so bullish that price couldn't even get there. It couldn't even get. Some smart money traders who were waiting for this order block, they couldn't even get into the move, right? This fair value gap was respected, and we quickly shot. Right? Not a lot of time was spent here. Look at this wick. Not a lot. There's only like a few days that we're actually in this fair value gap. The price quickly, sharply, massively moved up in the opposite direction. That right there tells us that we're so bullish. The respect of the fair value gap here, and the fact that we haven't even touched the order block, right? We haven't even touched the order block. So that right there is such a bullish sign. And now we're going to get onto the daily chart. We know we're bullish on the weekly and the monthly chart. We just want to see again on the daily chart, are we bullish? And then the 4 hour and below is just for entries. Just for entries only. And for the 4 hour essentially is just for refining liquidity, which is just key targets. So we'll talk about that later on. So let's get onto the daily chart and see what we can see. Okay, so here we are on the daily chart, and this right here is that, like weekly fair value gap. So let me just mark this out again. This right here is that weekly fair value gap, right? Price taps it, massively made it. Look at all these strong bullish candles. We get above these highs into the fair value gap here, right? This fair value gap here. and we have a little retracement down, and then look at this. I want to refine this again. So look at this. We're on the daily chart. See this fair value gap here? Look at this fair value gap. Look at that. See how we wick into it, quickly move off. Now, I know these candles aren't the best. There's lots of doji candles. But that's like, like I said, we're in December. It's normal to have these small little body candles. But we've got some news coming up, so hopefully price will start to move. But the fact that price has come in like this, it's tapped the fair value gap and moved off. That right there tells us that we're still bullish on the daily chart. We're still bullish. Now, obviously we've got little small candles. But like I said, it's kind of normal for this time of the year. And we've got some news later on, so hopefully that will clear it all up. But if price did something like this, let's say instead of wicking like through the fair value gap, if it was closing deep within the fair value gap, touching the order block, really low, deep retracements, then we wouldn't be as bullish, right? Then we could even be bearish, but we have such aggressive move out of it, right? Look at that, right? And let me just make this very clear. The wicks do the damage and the bodies tell the story. Now, what does that mean? Right? What does that actually mean? The bodies tell the story. What does that mean? The body didn't even get into the fair value gap. That tells us that we're so bullish. We're really bullish because the bodies couldn't even get into the fair value gap. The wicks tap the fair value gap and quickly move off, right? The damage, essentially, this right here was probably a stop run, right? Think about that. There's a daily low there. So this is a stop run on the lower time frames, and it's allowing smart money to buy in this fair value gap, right? There are smart money traders who just trade a daily chart, right? They don't go below the daily chart. In fact, most of them don't even go below the daily chart. A lot of them will also use the 4-hour chart, but they don't go below the 4-hour chart, right? So that the algorithms trade the lower time frames, right? Those who are running the algorithm trade like the 1-minute and 5-minute chart. But here, right, this fair value gap, lots of traders are buying this. Lots of smart money traders, lots of money is behind this move here, are buying because we're in this fair value gap. That right there, because we have a wick that taps it and moves off aggressively, that tells us that we're bullish. If we had a deep retracement, with large bodies closing into it, that would tell us that we're not really bullish, and we're either going to be bearish or just consolidate like that, right? So we know we're bullish on the monthly, we know we're bullish on the weekly, we know we're bullish on the daily, because we've had respect this fair value gap here. Price has tapped it, instantly moved off, aggressively moved off, tapped this fair value gap, and starting to move off. Obviously, it's December, we've got small candles, but I'm in live markets now. Hopefully, we do get some more bullish movement. So now we've got the direction on the monthly, weekly, daily chart. We know the higher time frame order flow. All you want to do now is want to get the 4-hour chart, and we just want to we want to see liquidity and key possible targets, right? Because the 4-hour chart is what I would recommend, the highest time frame that you really want to trade. The daily chart can be traded, but you're going to get very cute setup. So for me, let's get into the 4-hour chart and let's see what we can see there. Okay, so here we are on the 4-hour chart, and let me just make this a bit more clear. These wicks here, like I say, the wicks always do the damage, the bodies tell the story. These wicks here is just a stop run for these lows there. So let me make this a bit more obvious. Right here, we know there's lots of liquidity. Lots of liquidity this low. Everyone's buying gold. Everyone's trailing their stop loss orders. Lots of liquidity this low, right? And all these wicks, they poke down, instantly reverse up. That right there is your liquidity sweep. And I always talk about this. I always talk about waiting for a liquidity sweep, because the highest probability setups always occur after the liquidity sweep. And liquidity sweeps can be on all time frames, by the way, because someone was asking me this. It can be all the way on the monthly down to the 1-minute chart. There are liquidity sweeps everywhere. But the lower the time frame, the more likely there are to be liquidity sweeps. And in fact, if you go on the 1-minute chart, all you'll see is liquidity sweeps non-stop. And, sometimes, you see this in indices a lot, for those people who trade futures, and they trade indices in the 1-minute, let's say they're bullish, right? Everyone knows you've got your liquidity sweep here. So let's say this is a low. Price will come up. And, usually I always say, buy the fair value gap here that forms. But what normally happens for indices is they will come down, take out this stop loss again, so take out another low, then actually move up like that, and it can be so annoying. But the lower the time frames you go, the more liquidity sweeps you get, right? So that's just a general rule. But on the 4-hour chart and above, every liquidity sweep is super significant. So here we have our liquidity sweep. This wick right here, this massive doji candle. I mean, just look at it, right? This doji candle, the only reason it existed, right? I mean, that's a bit weird, but the only reason it existed really was just to come down, take out all this liquidity here, so smart money could actually start buying, right? Remember, smart money are moving billions in. They need billions worth of sellers. So right here, there's billions of dollars worth of sellers who have their stop loss in. Now, ideally, they don't want to sell, but their stop loss is going to trigger their entries and force them into the move. So right here, price comes down, smart money's buying, they're forced to sell, and we're also in a fair value gap here, right? So we just tapped this fair value. Let me make this a bit obvious. So, see this fair value gap here? Right, look at that. We just tap it, and that's because there's a lot of algorithms that are buying. Look at that. We just tap fair value gap. Tap it, instantly move off. Liquidity sweep into a fair value gap, massively move off, right? That's what we always like to see. And you know, this move here is a bit choppy, right? This move here is a bit choppy because we're in December. There's not much news. You know, it's not as clean as it should be, but we have this liquidity pool here. I mean, it's more obvious. This liquidity here, which gets taken out. Fairly deep retracement because we tapped this bearish order block, which, you know, ideally you don't want to see, but, you know, you're not always going to get this. And the lower the time frame you get, we have the higher time frame direction, which is bullish, but the more likely you are to see bearish, like, order blocks and fair value gaps get respected. Because what's really happening is, you know, on the overall time frames, price is going into a discount. So what does that actually mean, right? What does that actually mean? So right here, this is the Fibonacci. Every bit below the 50% level here is essentially a smart way of saying buy the dip, right? Anything below here, below the 50% level, because we're bullish, is cheap. So smart money are going to be buying. And you can just see, right? I mean, you can just see. Let me just make it more. You can just see, right? We've had a huge move up. We know we're bullish on the weekly and monthly chart. Remember, we've done all that analysis. Price comes into equilibrium, right? Just below the 50% level, shoots off. Comes in again, shoots off. Comes in again, probably like to shoot off. What's really happening here is every time it goes below 50% level, smart money are buying. So, you know, price may, let me just add to this, right? Price may just keep consolidating until like mid-January, right? Around here. And then, well, normally what would happen is it would take a stop run, right? Because we're bullish. Take out all these lows, move up like that, right? And this happens all the time on the 4-hour chart. Like, if you don't believe me, go back test this. Go look at December to January and you'll see consolidation. And let's say we're bullish, you'll see consolidation. Price comes out, takes out all the lows, moves up, retracement, and then continues on. That's what you'll always see. And trust me, I've backtested this so many times. That's what always happens. But yeah, the reason why we've got this a bit of a consolidation market is it's allowing smart money to actually buy, right? Buying a discount, buy cheaper. Let's just remove the Fibonacci. Let's make it a bit more clear. So there's lots of liquidity here. This doji candle too, which is quite important. I know it's really big. There's also an order block, right? The last down close candle before this, you know, big up move. Yeah, it's not the best order block. But let's just mark it out, right? Let's just mark out our order block like this, right? And you can see, look how price is respecting it. Now I know it's not the best. You get the bodies, but you know, you gotta bear in mind we have a huge order block, right? A huge order block, and we're not always gonna get what we like to see. But and this is something for your notes, right? This is something for your notes that's super important. So let's just get the Fibonacci on this order block. If price, let's say you've got a bullish order block like we have here, if price does not go below the 50% level of that order block, that tells us that we're really bullish. If price stays in the upper 50% of a bullish order block, that tells you that you're bullish. So we have this, price moves off, comes into the order block, but doesn't go below the 50% level, shoots off. Again, comes, you know, into the order block, but doesn't go below the 50% level. Does not go below it. And then hopefully it's going to keep moving off, right, like that. That's what we hope to see. Right, that right there tells us that we're bullish. We're still bullish. Price still, you know, the order flow is still bullish. This order block's being respected. It's being held. And if we look a bit more carefully, I'm just going to remove this order block, right? And let's just remove this too. If we look a bit more carefully at the most recent price action, what do we see here? What do we see here? Fair value gap. So let's mark this out again. Like that. There's your fair value gap. Right, there's your fair value gap. Price is being respected. We're wicking into it a few times. Now we're moving on. There's your big bullish engulfing candle. And, you know, we've all, I mean, this is probably easier on a lower time frame. So we've almost got, you know, liquidity around these highs here, right? So if you're a day trader scalper, this is your target around here, right? Your target's not this. But that's what the 1 hour, you know, 50 minute, 5 minute, all that's used for. And again, if you look really carefully, see the body of this order block, taps it, moves off again. But now, right, we know we're bullish on all the time frames, monthly, weekly, daily, 4-hour chart. Now we're going to get the 1 hour, 15 minute, 5 minute, 1 minute, all that sort of stuff. And just look for entries, right? And, you know, you can trade the 4-hour chart, and I trade the 4-hour chart, but it's a bit messy here, right? It's a bit messy here, but let's go into the 1-hour chart, and we're going to see what we can see there. Okay, so run the 1-hour chart, right? Run the 1-hour chart. At this point here, I know I don't talk too much about the 1-hour chart. At this point here, we're just looking for targets and entries. Right? We've done all the higher time frame analysis, and this is so important. The 4-hour chart is the lowest, higher time frame that you can use. Now, what does that mean? It means smart when you look at the monthly, weekly, daily, and 4-hour chart, like we've just done. Right? They're determining all their direction of the market based on those time frames, and they're looking at the lower time frames just for entry. Right? The only reason they're looking at the lower time frames is just to enter. That's it. And you should be doing the same, right? If you want to be a smart money trader, you want to be doing the same. So, I'm just gonna quickly point out we got this order block here. Look at the body of the order block. Body of the order block. Price wicks in, moves off. Now, in terms of entries, I personally don't trade the 1-hour chart, but this could be your entry. See this order block here? Enter at the body of the order block because, and this is something else we know, the body of the order block is the most important part, right? Not the wicks, the body of the order block. But, you know, if you need more help with order blocks, there's the video on the channel, and probably the last video I just did, on order blocks, so make sure you watch that. But what you're going to do, enter the body of the order block, put your stop loss at the low, right? You always put your stop loss at the low of the order block, including a wick, right? You never have your stop loss at the body just because it's too tight, right? If you've got the high time frame analysis, right, it doesn't really matter. But for the 1 hour chart, we've got lots of liquidity at this high here, right? Lots of liquidity, so let's mark this out. Lots of liquidity like that, right? Like that. We know lots of liquidity there. Very likely that price can come up here. No respect of any bearish order block. This wick here is almost the relative equal highs, and this could be a great entry. And personally, I'd aim for a 2 risk to reward ratio like that, 2 to 1. Nice and easy, high probability setup. High probability setup, right? And what's going to happen, what's likely to happen, is we've had our move up, price retraces a bit, here's your entry, maybe console it, maybe tap it again, and then go back up like that. Right, that's what's likely to happen. Nice, easy, high probability trading setup. All the hard work was done on the 4 hour, daily, weekly, and monthly. And we're just looking for entries now. And then on the 15-minute chart, I'm going to give you another entry that you could have taken. Okay, so we're on the 15-minute chart, and at this point, we're only looking for entries. Not doing any more analysis. We're just looking for entries. And for those of you who are a bit more eagle-eyed, right here, lots of liquidity, wick down, move up. This is your liquidity sweep. And I always say in the lower time frames, always wait for the liquidity sweep. And for me, the lower time frame is like the hourly and below. That's what I consider the lower time frame. It's what smart money considers to be the lower time frame too. So here, right here, it's your liquidity sweep, right? Liquidity sweep. So we've got our liquidity sweep, wick down, instant move up. And your entry, I'm just going to give you an order block entry. I know we talk about fair value gaps, but I know a lot of you struggle with order blocks. So this candle right here, the last down close candle for the up move is your order block. And the moment this body here, see this candle? The moment the body closes above this candle here, the order block, that's when it's valid. When the body closes above it, the bullish order block, that's when the order block's valid. And again, more examples in the order block video. So if you're struggling with it, make sure you check that out. So this right here, this last down close candle for the up move, this is your entry. You can enter like that, and the stop loss is going to be at this low here, or even this low here. Doesn't really matter, right? Because both of these are essentially at the same level. Both of them are essentially at the same level. If you really want to be safe, you can have a stop loss here, or you can have it here. But the key thing is, you always want it at the swing low. Right? You always want it at a low. So take profit is going to be at least 2 to 1. Let me make this a bit more clear. Remember, on the 15-minute chart, so you can hold for a longer move. And this entry right here is in Asia. I know a lot of people trade Asia. Gold moves a lot in Asia. Trust me, I used to trade gold in London, and the whole move would happen in Asia without me. And yeah, there's some great moves in on gold in Asia. So yeah, aim for a 2 to 1 like that. Or if you really want to push it, you can aim for a 3 to 1, which you just about get with spread like that. Just about get it. But this is why I always say, always take the easiest low-hanging fruit. So 2 to 1's always easy, and at most a 3 risk to reward ratio, right? At most 3 risk to reward ratio. And yeah, that's a simple entry you can take on a 15-minute chart. Does not matter. You can take the fair value gap here. This could be in your entry. Anything could be your entry. The fair value gap, you could literally buy as price is going down, but I wouldn't recommend that. And fair value gap, order block, optimal trade entry. See, we actually get the optimal trade entry like that, right? And we just look at that. We just miss out on the optimal trade entry, where you've got the fair value gap and you've got the order block. The entry pattern, this is so important. The entry pattern is the least important thing. As long as you've got the bias and direction right, any entry pattern will do. Any entry pattern will do. Wait for a liquidity sweep and then enter on that. And yeah, now I'm going to get to the 5-minute chart, and I'm going to give you another entry. Okay, so we're in the 5-minute chart, and this is actually a great example because we're literally in live markets, and right now it's literally 7 a.m. New York time. You probably can't see it because my camera's in the way, but right here, 7 a.m., this is New York session. And you see this fair value gap here, London. This right here can be your entry. This right here can be your entry. And look at that, already we're starting to respect it. And what you're going to do, enter like that, stop loss at this low here, target a 2, risk to reward ratio like that, or a 3 risk to reward ratio. And just look at that, easy liquidity here and here. Nice, easy, high probability setup. And we know, and this isn't a New York trading video. We've had lots of videos on the channel about that. But what we have, continuation of London. Typical for New York, continuation of London's move. London's bullish, retracement, continuation. Simple, nice, easy, high probability setup. And the hard work was done on the higher time frames. The monthly, weekly, daily, full hour. That was all the hard work. Right? We've done all that. Nice, easy, high probability setup. And finally, I'm going to get onto the 1-minute chart, and I'm going to give you a 1-minute entry. And I don't talk much about the 1-minute chart, but it can be traded. I'm going to show you how to trade it now. Okay, so last but not least, we're on the 1-minute chart. And for the 1-minute chart, you're just looking for a quick scalp. I personally, if you're trading the 1-minute chart, I wouldn't go for more than a 2 risk to reward ratio. Some people have a tiny stop loss. Let me just make it clear. Some of them have a tiny stop loss, and they hope to get a huge risk to reward ratio. Let me tell you something. You don't need that. All you need is a 2 or 3 risk reward ratio and a 50% win rate, and you can make all the money in the world. All the money in the world. Ignore anyone saying you need, a 10 risk reward ratio and a high win rate. You do not need that. But yeah, we're on the 1 minute chart. We've got a little bit of a liquidity sweep here. I know the 1 minute, obviously, the liquidity on the 1 minute chart isn't anything compared to, let's say, the 4 hour chart. But you've got a low here, price comes down, quickly, aggressively shoots up. We know the higher time frame is bullish. We're looking for any reason to enter, and we've got this big fair value gap here. Big fair value gap entry here. And because you're on the 1 minute chart, you can be a bit more aggressive with your entry. Now, what do I mean by that? It's more obvious. So you're entering on the fair value gap like that. Your stop loss, at a minimum, has to be at this candle here. Why does it have to be at this candle here? Because this was the candle that formed the fair value gap. Right, the fair value gap is formed by this candle, and this candle. So the stop loss has to be at minimum for a bullish fair value gap at the low of the candle that formed the fair value gap. So the minimum it should be is here, and then it could also be here, right? But if you're on the 1 minute chart, you want to be a scalper, you want to be aggressive, this is what you do, right? So you can aim for a 2 to 1, like that. Easy 2 to 1. Do you get a 3 to 1? Just about in this case, just about. But yeah, it's a 50-50 whether you're going to get a 3 risk reward ratio. A 2 risk reward ratio, you can get this multiple times a day. And this was an easy setup that you could have got in London. And it's also, for those of you who know, it's a silver bullet. And the silver bullet, you don't need to worry too much about it. It's essentially ICT's trading strategy, which is between 3 a.m. till 4 a.m. There's likely a large price move that occurs, and it leaves a fair value gap, and you just enter the fair value gap. Nice, easy trade, right? So we've got bullish move, enter on the fair value gap there, right price up. Nice, easy, on the 1 minute chart. This occurs a lot on the in indices and Forex. With Forex, you really get, so let's say you're trading Eurodollar, you can trade it from 3 a.m. till 5 a.m. Eastern. That's absolutely fine. But right here is your silver bullet, golden entry, fair value gap, higher time frame buys, everything you need on the 1 minute chart. And that's every single time frame covered, all the way from the monthly down to the 1 minute chart. And, that's how you use them. The key thing is monthly, daily, weekly, sometimes the 4 hour for the direction, but monthly, daily, and weekly will tell you everything. And then when you get onto the 1 hour, 15 minute, 5 minute, and 1 minute, you're just looking for entries. That's all you're doing, is just looking for entries. And all you really need is a 2 or 3 risk to reward ratio, trading the higher time frame bias, and a 50% win rate, and the liquidity sweep before you enter, and you can be profitable. You can be profitable. The entry pattern is the least important thing. Just focus on getting into the move and being realistic with your targets. Okay, so the first thing you want to see is a liquidity sweep. I talk about this all the time on the channel, but we always want to see a liquidity sweep. Now, what is a liquidity sweep? A liquidity sweep is, let's say you've got some highs, right? You've got some key highs like we have here, right? We've got highs here, or we've got highs here. What we want to see when we're bearish is we want to see price come up like this, take out these highs here, instantly reverse, come back up, and ride price down. That's what we want to see, right? We want to see a wick that pokes up like this, takes out some liquidity, instantly reverses, ride price up, and then continue it down, right? That's what we want to see. Nice and easy, high probability setups. We always wait for a liquidity sweep, because if you don't wait for a liquidity sweep, you're going to get swept. And how many times have you got the bias, right? How many times have you known that it's going to be bearish, right? Let's say you shorted here, you shorted out. Let's say this fair value gap. Price comes up, takes out your stop loss, and then goes off without you like this, right? How many times that happened? It's because you don't wait for a liquidity sweep. And London session itself is characteristic, right? This is a key thing that London does. It always has a liquidity sweep. It always has a major liquidity sweep, and then it moves in the opposite direction, right? So you always want to wait for it. And London session really is 2 a.m., which is around here, 2 a.m. Eastern, New York time, all the way up until 5 a.m., which is all the way down here, right? And you can just see the real meat of the move is from here to here, right? And then you get a bit of retracement. Right, that's the real meat of the move. So you want to be trading 2 till 5 a.m. That's the absolute golden zone. And right, so we've got these key highs here. Let's mark this up. We've got these key highs here. Now, why do we care about these highs? We know there's lots of liquidity, right? Lots of liquidity at this high. And look at this, right? You see how price comes up with a wick, instantly takes it out, and then drops massively. Drops massively. That reversal right there with the big fair value gaps. That's smart money telling you that this was just a liquidity sweep, right? Let's mark this up. This was just a liquidity sweep. Price only came up to here. It only came up to here just to take out this liquidity. That's it, right? Price came here, right up here, took out liquidity, dropped massively, and now we want to enter on the retracement. We want to enter on this retracement up, and then we want to ride price down, right? That's what we really want to do. You always want to wait, though, for this liquidity sweep. Always wait for some high to be taken out when you're bearish, or wait for some sort of low to be taken out when you're bullish, right? That's the highest probability setup, so make sure you always wait for that. So we've got our liquidity sweep, we have a wick, sharp move down, and now we just want to enter on a bearish fair value gap, right? Any fair value gap will do, because fair value gaps, and this is so important, when a fair value gap forms, especially in London session or any session in particular, but when it forms at a key time of day, it's such an important fair value gap, right? It's such an important fair value gap. And do you remember how I said 2 a.m. literally right here? This is when London session actually starts, right? Now the liquidity sweep can happen before London, absolutely fine, but 2 a.m., which is right here, we're going to start looking for entries. Now the first fair value gap that forms there is so important. It's so important because that fair value gap is essentially telling you the bias, right? It's essentially telling the bias. And just look at this, right? Look at how the bodies like close within the fair value gap. And I know it slightly wicks up, but look at the bodies, right? The bodies tell the story and the wicks do the damage. Right? That's the reality of it. And if you look at this fair value gap, it's holding price within it. It's holding price within it, and we're bearish. So we just want to enter on the fair value gap. But the first fair value gap that forms, especially after a liquidity sweep like we've had here, is so important, and it's usually the best entry. It's usually the best entry. So what we're going to do, we're going to enter like that, right in the fair value gap, like this. Stop loss is going to be at the high. And I always say this, why is it at this high here? Because we've had a liquidity sweep. And this is the only reason we care for a liquidity sweep, right? It's just so we can put our stop loss in a safe area. And the reason it's safe, let's talk about this all the time. Price came up here just to take out these highs here, right? Lots of liquidity, lots of highs here. This is the previous day's high. Lots of liquidity here. So price came just to take this out, right? And now price massively, aggressively dropped. It aggressively dropped, right? Very, very unlikely in London session at key time of day, that price is going to come all the way up, take out your stop loss, which should be here, and then continue down, right? Very unlikely. And the reason it's unlikely is because let's say you're a scalper or day trader. London session is only 3 hours long, right? And with the 5-minute chart, there's only so many candlesticks that can get printed. Right? There's only so many candlesticks that can actually happen, right? There's only so much messing around that can actually occur. So, you're not really going to see a double liquidity sweep, right? Price is going to quickly move. It's going to take liquidity out, and it's going to quickly drop in the opposite direction, right? That's what price does. It takes liquidity, it drops, and then it gives you a second opportunity to get in, right? This is for smart money traders to get in, and then it drops massively, right? Like it does here. That's the reality of London session. So what you're going to do, stop loss at this high, nice safe stop loss, and then you're going to target 2-3 risk to reward ratio. Now, I say personally, I say this quite a lot, don't target more than a 3 risk to reward ratio, just because, like if you target a 4-1, I know you get it in this, trade, but usually what happens is, let's say you've done this, so you've entered perfectly, you're up, let's say 3%, and then sometimes price just consolidates, or even starts reversing against you, right? Look, if you can get a 3-1 consistently, like, let me tell you, you can make all the money in the world. I get a 3-1, that's what I aim for personally. But yeah, this is such a fantastic model. It occurs all the time. Wait for the liquidity sweep, wait for a strong fair value gap to form in the opposite direction. That is smart money telling you there's a reversal, and this is so typical for London. It has a fake move, right? A fake move up when you're bearish, takes out some sort of liquidity, instantly drops, gives you a second chance to get in, bam, right price down. That's simple. And I'm going to give you another example in a different pair now. Okay, so we're on our second example. We're on dollar against the Swiss franc. And this is another brilliant example. And you don't need daily bias for this. Now, why don't you need daily bias? This is so important. It took me about almost 2 years to realize daily bias and session bias are two different things, right? You could be bullish on the higher time frames, but for London session, you could be bearish. Now, why is that? And let me give you an example. Let's just say we're bullish, right? Let's say we're bullish, and let's just suppose this move up is the 4-hour chart, right? This big move up here is a 4-hour chart. Price will often retrace, right, around here on the 4-hour chart. And let's just imagine there's like a fair value gap order block here, right? And then price will continue up. And we're just going to suppose that this is the 4-hour or even the daily chart. And let's just suppose further that there's some sort of 4-hour fair value gap back here, right? Smart money themselves, they're looking at the 4-hour chart to execute their orders, right? They're moving billions in. They can't move billions on the 5-minute chart. They're looking at the 4-hour chart. So price, right, even though it's bullish on the higher time frames, it could spend a few days being bearish, retracing down into this fair value gap. And then once it hits this fair value gap, smart money is going to buy. Price is going to continue up. So this is why, even when you're bullish on the higher time frames, London can be bearish, right? It can be bearish because you could have a few days. I mean, remember, this is the 4-hour chart. This could be a week. This could be a bearish week where price is coming down into a discount, which essentially just allows smart money to buy. And, you can short during this mute, right? That's why I say, daily bias, because in this scenario, the overall daily bias is bullish. But this retracement here, there's lots of opportunity if you're a day trader or scalper. And this is why I say session bias is different from daily bias, right? The daily bias here overall is bullish, but the session bias here is bearish, right? I hope that makes sense, right? A bit complicated, but, if you understand that, there's a lot of opportunities in trading. A lot of opportunities. Okay, so here we are, during London session. London session, as always, 2 a.m. Right? And just look at this, right? 2 a.m., little pump up, takes out this high, instantly drops, comes back up. So let's mark out our liquidity sweep. And I hope it's obvious. At this high here, lots of liquidity. And this is Asia's high too. Now, this is what you notice. The liquidity sweep doesn't always have to be Asia's high or low, right? Because sometimes, you rarely get that. Because let me just mark this out again. Sometimes what you get is, let's say Asia has a huge range, right? Let's say you've got, this is Asia's high. This is Asia's low. London might be in the middle of this. And this could be like 10, 20 pip moves, inside London, right? But just because Asia's a big move, doesn't mean you need to target the highs and lows. Because you see this a lot with gold, right? Gold will have a huge move in Asia. And, you can't always just wait for London to sweep out, let's say, Asia's low, and then enter a retracement. Because you won't always get that. So any significant high or low will do. But in this case here, we've got Asia's high, right? So we're going to mark this out. This is our liquidity sweep, right? This is the first thing we're looking for. We're looking for a liquidity sweep. We're looking for price, take out a high or low, like it does here, takes out a high or low, and then quickly, aggressively, sharply move in the opposite direction, right? Now look at this, right? Look at this. I know we get like a few bodies closing above it, and someone was telling me, if a body closes above it, is that not a liquidity sweep? No, it's absolutely fine. I mean, just look at these candles, right? Look at these candles. Is that bullish at all? Are any of these candles bullish at all? No, right? If it went all the way up here, massively closing, that would look bullish, right? That would be like a bullish move. But because we've just let's move this up. Because we've just poked through it like that, we literally just poked through it, massive aggressive move down. We're not do that. That's literally what we want to do. We want to see price retrace up, ride it back down, right? And look at these big fair value gaps. The big fair value gaps here. This is smart money telling you there's a reversal. I mean, just look how sharply it dropped. Look at these fair value gaps here. Look at these strong, aggressive candles down compared to this move up. This is supposedly a bullish move. Look at all these large wicks, gapping, not high probability at all. Massive move down, ride price up. That's what you want to do. That's the exact type of trade we want to be in. Right? The exact type of trade we want to be in. Look how clean this move is. This clean bearish move. And, for those of you who know, technically it's a market structure shift when the body closes below here or even here. Now, I don't really like market structure shift because, the reality is these markets move for liquidity. Right? They move for liquidity, not market structure. They move for liquidity. And, if you look at this low here and this low here, it's essentially almost relatively equal low. So we've got lots of liquidity here. Nice, easy, high probability setup. And we just want to short at the fair value gap. And someone was also asking me this. Does it have to be a fair value gap? No, I'll just show you both examples, right? It doesn't have to be a fair value gap. Fair value gap's just easy for everyone to, because everyone understands it, don't they? So, like we said, stop loss, regardless of where you enter, has to be at liquidity sweep high, right? Because if it's not at liquidity sweep high, and someone on Twitter was showing me this, right? Their stop loss was like this. Literally, it was at the stop, and it was at the top of the fair value gap, and they got taken out like this. And then price goes right in their favor. So they were targeting like a 3-to-1, right? The reason why we don't put a stop loss here is because we actually want a liquidity sweep. It's pointless to wait for a liquidity sweep and then put a stop loss here, right? It's pointless to wait for a liquidity sweep if your stop isn't at the liquidity sweep high, right? There's no point in even waiting for a liquidity sweep because you're not even using it. The whole point of a liquidity sweep is there's a safe area to put a stop loss, right? Very safe area to put a stop loss. That's the reason why we actually wait for liquidity sweep. So, for those who are wondering, that's why we actually wait for liquidity sweep. Stop loss always at liquidity sweep high or low, right? Never at like a fair value gap high. Always at liquidity sweep high. And then for take profit, as always, you target at least 2-to-1. Let me make it a bit bigger. At least 2-to-1 or 3-to-1, which just about get here, right? Nice, easy. And this is why I say don't target a 4-to-1, right? Just target a 3-to-1. I know we got it in the last example, but a 3-to-1 at most is easy, high probability, bread and butter setups, and this occurs all the time. And very quickly, let's say you didn't want a fair value gap, right? For whatever reason, you don't like the fair value gap. You can take the order block as your entry. First, let me make this a bit bigger. The order block, which is the last, because we're bearish, the last up close candle for the down move. That's your order block, right? I've got a video that I did maybe like a week ago, right, on order block. So make sure you watch that. But right here, this is your order block. Now, some people will say this, but for me, this is the order block because, and this is something else you notice, an order block that has a fair value gap attached to it, like we have here, is very high probability. So notice that because the order block here has a fair value gap attached to it, very high probability. Whereas this order block here, some might say this last up close candle for the down moves an order block, and you've got all this choppiness, right? You've got all this choppiness, so it's not really high probability. But this order block here, very high probability. So you can enter on the order block like this, right? Stop loss again, always at liquidity sweep high, never at the high of the order block like that, right? Because you probably lose your spread, right? I mean, literally it taps your stop loss. So always at liquidity sweep high. That's the whole reason why we wait for liquidity sweep high. Is so we can actually put our stop loss there and take profit. You're gonna target at least 2-to-1 or an easy, high probability free risk to reward ratio. That's all you need. I'm telling you, I spent years trading London session. I've literally condensed it to the simplest trading model possible. Yeah, if you can follow this, you'll see this almost every day. Almost every day you'll see this setup in one of the majors. Now, what do I mean by one of the majors? This is my watch list. Let me get it up. So the majors literally being Euro, GBP, AUD, NZD, Dollar CAD, Dollar Swissy, and Dollar Yen. Right, and one of these 7 pairs, and gold. You can have gold for that. XA or USD. So in one of those 8 pairs, really, there'll be a sell. There'll be a sell in London. You just have to look for it. And again, I know I'm ranting a bit, but this is the reason why I don't believe in just trading one pair. If you trade one pair, you're gonna get, you'll get this sell maybe like once every week if you're lucky, maybe like once every 2 weeks, and then you're gonna be impatient. You're gonna take setups that aren't high probability and lose. So for me, I'd always have like a basket of currencies, just quickly filter through, see which one looks obvious, take the setup, and yeah, all you need to be a profitable trader. That's all you need.
Okay, so you read the title, you know what the video's about. What you want to do is you want to wait for a sweep of London's low or London's high. Now, what does that mean, right? Any time before 7 a.m. is essentially London session. And what you want to do is you want to find the high and the low. So the low, in this case, is this low here, right? Pretty simple, pretty easy. What you want to wait for is you want to wait for New York, which starts at 7 a.m. here. You want to wait for it to sweep out a low or a high, right? London's low or high. And this is key because this will tell you the bias. And the reason you know it's a sweep is you can see all these wicks here. You see these candles are like all wicky. It wicks down and it instantly shoots off. And as it instantly shoots off, it leaves behind a bullish fair value gap. Now, the moment it leaves that fair value gap behind, that is essentially smart money telling you that the direction is now a reversal. Because New York always does this. It will sweep London's low when it's bullish and then go the complete opposite way. And when it's bearish, it will sweep London's high and then go the other way. Right? It's just the highest probability setup just to wait. So just always wait for that sweep. And once you've got your sweep, wait for a fair value gap to form. Because the fair value gap tells you essentially that there's going to be a reversal of direction. Because the fair value gap after a liquidity sweep in the opposite direction is very, very good for bias. Very good for bias, yeah. You don't hear many people talking about that. So you've got your fair value gap, right? What you're going to do is you mark it out like that, nice and easy. You can enter right at that fair value gap there. Because that's what I would do. I'd enter right at this fair value gap, like that. My stop loss would be at the low of the candle that causes the fair value gap, right? Because remember, all this is a liquidity sweep. So if price is bullish, there's very little reason for it to come all the way down and take out these lows and then go back up, right? Remember, because you're a day trader and because you're trading New York session, there's only so many candlesticks that can print, right? Like price has to move quickly. It has to move somewhere quickly. And we're on gold, right? So we know we're in a bull market. And you've got your liquidity sweep. Price is quickly displaced up. You've got your fair value gap. There's your entry. Stop loss at the low of the candle that forms the fair value gap. Take profit. I'd say always a 2-to-1 at least. Or you could just aim for London's high like that. Right? I'm telling you, boys, it's that simple. This setup occurs all the time. Like all the time. Just look through your charts and you'll constantly see this. Just wait, right? And this is the key. Just wait for New York session. So 7 a.m. Wait and see what happens there, right? Because here it's 7 a.m. Right? At this moment, this tiny little green candle, it's 7 a.m. That is New York session. Right? Everything before it, so there is London's high. Here's London's low. Don't try and predict that. Oh yeah, we're gonna go bounce down like this into this fair value gap and go up. Because lots of people would have done that. Lots of people, right? They know we're bullish on gold. What they would have done is, let's just remove this and this. What they would have done is they would have been like, oh well, there's a fair value gap here, right? Why don't I just enter there and then put my stop loss here? So what they would do is they'd be doing this, right? Because everyone knows that New York is usually a continuation of London. So what they will be doing is buying this fair value gap here, buying this fair value gap out here, and then they get swept. And then they're right with the bias, and then they get angry, right? The reason why is because they've not waited for a liquidity sweep. And when you trade New York, always wait for London's high or low to get swept. Yeah, and I'm going to give you another example, which is literally, I think it's, let's just look at it now. I think it's the day before, right? Yeah, here's our next example, right? Here is London's high, right? Let me just mark this out. Right here is London's high. And can you see how all these candles are like wicky, right? See how it just wicks up and then it goes down. You have a little strong body here, and then we got a doji, huge displacement downwards, right? Huge displacement downwards. This right here is smart money telling you there's a reversal. We've taken out London's high. We've still got London's low, which is around here. I know technically this is 7 a.m., but this is essentially London's low, right? It's not really taken out much. So there's lots of liquidity here. Lots of people have gone long. Right, so we've got our liquidity here. We've had our liquidity sweep. The moment we get these huge down close candles, we've got a giant fair value gap that we know price is going to go and refill. You've got an order block too. So what you're going to do is mark out your fair value gap like that. Enter at the fair value gap. You can even take the midpoint of the fair value gap because it's quite big. And then you're going to target at least a low here, right? But then you don't even get a 2 to 1. So I would always say aim for at least a 2 to 1. Like that. That's your setup right there. Right, and this is literally the day before. Yeah, so the day before and then the day after. And these setups occur all the time. Like all the time. Wait for a sweep of London's high or low. Wait for a fair value gap in the opposite form, opposite direction to form, and enter on that fair value gap, and then target the opposing liquidity pool, or a 2 to 1 risk to reward ratio. And yeah, boys, it's that simple. That's how you trade New York. I think it's probably the easiest session, and this setup works on all forex pairs. It works on gold. I don't think it works on indices because of the indices open stuff, but I mean, I don't know. I've not really checked it out there, but yeah, this works on forex. It works on gold, and I hope you liked the video. It's that simple. If you did, like, subscribe, leave a comment for the algorithm, and peace.
Okay, so the first thing you want to do is you want to get onto TradingView and you want to get onto regular trading hours, right? You don't want to be on electronic trading hours. You want to be on regular trading hours because what this does is it essentially gives you the 9:30 a.m. open. And this is a pro tip, right? Don't trade indices before the 9:30 a.m. open because it's just, there's not much volatility and it's just a waste of time, to be honest. And when you go on the regular trading hours on TradingView, what you get is you get the previous day's price action, right? And then it ends at 4 p.m. Now, this is a bank holiday. So it ends at like 1:15 p.m. But usually it'll end at 4 p.m. Right? So right here, this candlestick, 9:30 a.m. And this will be from 9:30 all the way up till 4 p.m. Right? When indices close. After that, we don't care about any price action. We only want to trade indices between 9:30 a.m. all the way till 4 p.m. Right? That's the first thing you want to do. And here's the pro tip. Right? This is what all the pros do. Is they skip the first 30 minutes of indices. Right? You don't need to trade the first 30 minutes because the first 30 minutes. It's a fake move, right? The first 30 minutes is a complete fake move designed to trick retail traders. And just look at this, right? So we consolidate for a bit. We drop massively. This drop here, let's make this a bit clearer, right? This drop right here, this is making retail traders chase price, right? Chase price, because they think this is a breakout, right? They think the market's consolidated and bam, we broke out. So they're selling, right? Now, those who actually, earn smart money, those who know how to trade, what they're going to do is they're going to let this fake move happen and then they're going to buy and then they're going to ride price in the complete opposite direction, right? And when I used to trade indices, I literally would buy, like rightly open. As soon as there was any sort of movement, like out, I would buy or I would sell, right? And there are so many retail traders who do this. So this is a fake move, right? 9:30 a.m. Eastern, all the way up until 10 a.m. Where is it around here? This is a fake move, right? 9:30 a.m. till 10 a.m. is a fake move. Now, the way you actually trade this is you wait until 10 a.m. Eastern. Right, just have some discipline. Wait till 10 a.m. Eastern. Don't even look at the charts until like 9:55 a.m. Eastern, because that's helped me out a lot. Right? Don't even look at the charts because you might get tempted. Ignore the first 30 minutes, right? Because it's random. It's almost like gambling, and it's a fake move. Okay, so now that we've ignored the first 30 minutes, what we actually want to do for this trading model is we only want to look for our entry between 10 a.m. Eastern, which is here, all the way up until 11 a.m. Eastern, which is all the way over here, right? This is your golden zone. This is the absolute best time to trade futures because you get the first 30 minutes, which is a complete fake move, and then you get the real move, the real meat of the move, which happens 10 a.m. to 11 a.m. Eastern, right? So for this entry model, only trade between then. I'm telling you, it's such an easy, high probability setup if you only just focus on that time frame. And what you want to do, and this is so simple and it's so misunderstood, is you want to wait for the first fair value gap that forms on the 1 minute chart between 10 a.m. which is here, to 11 a.m. Eastern, because that first fair value gap is very, very significant. All right, you don't often hear about this, but the first fair value gap that forms between 10 a.m. to 11 a.m. is very significant. Now, what do I mean by that? This right here is a fair value gap. Now, fair value gap is just, let me write this out. See, this candlestick's high here, and this candlestick's low here. This forms a gap, right? This forms a gap. Now, why is that important? A fair value gap is essentially, prices quickly moved in one direction. It quickly moved in one direction and had very little time to retrace, right? Because if there was a retracement like this, right? There was a retracement like this. Price would have quickly come down like that and come up. There would have been no fair value gap. We don't have that. What we have is price quickly, sharply, aggressively moves in one direction. It leaves a fair value gap. That is smart money. This entity who moves the market are telling us where price actually wants to go. That fair value gap is a massive hint for those who know those who actually know how to trade, right? The fair value gap, it's a massive hint for where price wants to go, right? It's so important that you wait for that. So you wait for the first fair value gap that forms on the 1 minute between 10 a.m. to 11 a.m. Eastern, and then you just enter on that fair value gap, right? It's as simple as that. You enter on that fair value gap, and what you're gonna do, enter on the fair value gap like this, put your stop loss at the swing low, like that, right? Always put it at the swing low. It's just a nice, easy. You don't need a really tight stop loss, especially on the 1 minute chart, right? And for take profit, you're going to target at least a 2-to-1 or a 3-to-1 like that. Like this, right? Like that, right? Like that. There's your 3-to-1. Nice, easy, high probability scalping model. And this is what I usually do all the time when I trade futures, right? This is such a great model. And there's actually another secret golden nugget that I'm going to tell you. So let me just remove this. You see this gap here? This is another reason why I like the regular trading hours. You see this gap that forms between Thursday and Friday's price action, right? We're completely ignoring all the price action that happened between Thursday to Friday, right? We only care about when indices were actually open. Now, you can see, right, just by looking at the charts, and because we've got regular trading hours, there's a big gap, right? There's an actual gap. This gap here, like this, right? This is what you call an opening range gap, because as soon as the market opened, this was the gap we have. This gap, and this is for your notes, this gap likes to get filled. Price does like to fill these gaps, right? So what I mean by that is what you usually get is you get the fake move, and then price will start to retrace all the way up, and it will fill that gap, right? It will fill that gap. Now, why am I telling you this? I'm telling you this because that gap can make a good entry, can make a nice entry. Now, I'm not, I'm a big believer in just taking a 3-to-1, but if you wanted to take, let's say partials, let's say half your position off a free risk to reward ratio, like that, you could hold all the way up until this gap here, until the gap gets filled for a 4.67 risk to reward ratio. Now that's more risky if you want to pass a prop firm customer. You could do that, but just know that this gap here, this big gap here, does like to get filled. Price does like to refill these gaps, and then maybe it'll go the other way, but it does like to fill these gaps. And yeah, I mean, it's such a simple trading model, right? Wait for the first fair value gap that forms on the 1 minute chart between 10 to 11 a.m. Eastern. Enter on that fair value gap, aim for a 3-to-1, and yeah, you can be profitable on that. Okay, so here we are on the Dow Jones, and like we always do, we wait for 10 a.m. Eastern. Right, we completely forget about this move. We wait for 10 a.m. Eastern here. We wait for the first fair value gap that forms on the 1 minute chart, which is this fair value gap here, like this, like that. We enter on this fair value gap, like this. Put our stop loss at the swing high, like that. And then we target a 3-to-1 at most, or a 2-to-1. Right, like this. So there you go. Nice, easy, high probability set. Now, this is why I'm a big believer in just at most aiming for a 3-to-1. Because if you aim for a 4-to-1, like, you just about get it. But if you keep aiming for, a higher and higher and higher risk to reward ratio, you're going to miss out. Especially for indices on the 1 minute chart. Like, at most, aim for a 3-to-1. Or at least take partials, right? So 3-to-1, nice and easy. Easy, high probability risk to reward ratio. But a 3-to-1 risk to reward ratio is perfect, like that, right? Like that, if I can get it right. Like that, nice and easy. This model works, it works so good. Like, it works so good, right? Ignore the first 30 minutes that indices open, wait for 10 a.m. to 11 a.m., enter on the first fair value that formed on the 1 minute chart, aim for a 2 or 3 risk to reward ratio, and I don't know if you can make futures any more simpler than that, but this model works. Backtest it, try it out, and yeah, have fun with this. Now, the best and easiest way to trade stocks is to use the higher time frames, right? And I know it's not sexy. Lots of people are obsessed with day trading. And let me tell you something, right? And this applies to all markets. And if there's one thing you take away from this video, let it be this, right? The fastest and easiest way to make money in trading is to use the higher time frames, right? Use the higher time frames and trade them directly. Be a swing trader. I'm telling you, I've spent years learning how to trade. As soon as I became a swing trader, so easy. Everything's easy. Day trading is so much harder than swing trading, and you're prolonging your journey by at least a year if you're obsessed with being a day trader. I'm telling you, if you've got a job, if you're studying, be a swing trader, become profitable as a swing trader, become financially free, and then once you're financially free, then you can become a day trader. I'm telling you, being a swing trader is so much easier than being a day trader. You don't need to be on the 5 minute chart. You don't need to be on the 1 minute chart. You don't need that to make a lot of money. Because trust me, I'm a swing trader. I make a lot of money. And you can make an infinite amount of money with swing trading. But what we do is we get on the 4-hour chart and we look for the most obvious liquidity pool, right? And this works in all markets. Liquidity is what drives every single financial market. If you've got candlestick charts like this, liquidity is what you need. So we get on the 4-hour chart and we look for where people's stop loss orders are, right? Think of typical support and resistance. So right here, we're on Tesla and we're looking for, let's say if we're at this point in price action, we're looking for obvious support or resistance, right? Where would people have their stop loss orders? And if you look at this level here, right, we've all studied support and resistance. What do they say? Price is going to come up, it's going to bounce off this level, and that you can short and you can put your stop loss at this level here, right? At this level here, and it's nice and safe. So what this is what retail calls resistance, but what smart money, and we want to trade like smart money because these are the ones who are actually making money in these markets, right? Everyone knows the stat. So this is about wrong, right? Everyone knows the stat, right? Like 90% of traders fail. The reason why 90% of traders fail, and I'm absolutely convinced of this, it's not because of their psychology, it's not because of any of that. It's because they don't understand how to actually read these markets. They don't understand what's going on. And to be honest, you're not supposed to understand what's actually going on, right? These markets aren't designed for you, being a retail trader making thousands of dollars. It's designed for those who have billions, right? It's not designed for me and you, but we can trade like those who actually know what they're doing and we can make money. So at this level here, lots of retail traders and retail funds think this is good resistance. They think price is going to come up to this level and bounce off. So they think it's nice and safe to put their stop loss orders around here. What that means is for, a key financial market, a key financial stock like Tesla, there are billions of dollars worth of stop loss orders at this level, right? Around $236, right? Lots of money here, lots of stop loss orders, and the market will only move for where the money is, right? It will only move for where the money is. That's what the markets do. They don't, price is always moving for something. It's always moving for either a key liquidity pool, right, which is like their support and resistance, and to target support and resistance, right? Not to bounce off those levels, to target support and resistance. Or it's moving to an inefficiency. Now, we're not going to talk about inefficiencies in this video because it's not important. And liquidity by far is the most important thing, and it's the lifeblood of the markets. It's the real reason why they move, because if you've got smart money traders, essentially those who actually know how to trade, who have billions of dollars, and every trade they're making is worth billions of dollars, they need someone else who's going to be selling billions of dollars, right? They want to buy Tesla, billions of dollars worth of Tesla. They need someone who's going to be selling billions of dollars of Tesla, right? And that's why they target people's stop loss orders. So the market will move for key highs like we have here and key lows, right? But right now, we're bullish, right? So what we're going to do, and this is so important, right? Because this took me about, I want to say about a year and a half to fully understand, right? 2 years, I mastered this concept. And right now, I will show you literally what I do as a trader, right? All I look for is key liquidity on the 4-hour chart, right? Like I've said, and I just take a Fibonacci retracement because the entry pattern is the least important thing. So Fibonacci from this low, right, to this high here, right? You see how this high comes up and it's the same level as this resistance and starts moving down. Lots of traders are going to think that, this is working, it is working, look, resistance is working, we've come up here and now we're going down. So they're going to short, even more confident to put their stop loss orders around here, right? Now for me, I love seeing these equal, let's just remove the Fibonacci, right? I love seeing these equal highs, right? See how we've got highs here and highs here? I love seeing that because for me, I know retail traders, as price starts moving down, they're going to be selling, and there's going to be even more stop loss orders here, right? And the real reason why price actually dropped here was to generate more liquidity, right? Just to get more people shorting, and putting their stop loss orders here, right? And so for the entry pattern, literally all you need to do, Fibonacci from the low to the high like that, and then we enter at the 0.705 level. So let me just quickly get the settings up, right? 0.705 level. And let me tell you something, I think this is the easiest entry pattern in all of trading, right? This is probably the easiest entry pattern in all of trading. And this is called the optimal trade entry. The name doesn't matter, it's just a Fibonacci retracement. And let me just tell you something, right? Because a lot of people, they use the Fibonacci completely wrong. A lot of people think there's some magic in the Fibonacci, right? You've heard, you must have seen, all those numbers, right? The squiggly lines, all those numbers, it's key numbers. That's a load of crap, right? Markets aren't moving for some random numbers. It's just a nice, easy way of saying, buy the dip, sell the rallies, right? That's all it is. So we're going to enter the 0.705 level, like that. Stop loss at the low. And personally, I always target a 3-to-1. Right? I always target a 3-to-1 like that, right? Nice, easy, high probability sell. And this is what I do every single day. I do it on indices, I do it on crypto, I do it on Forex, commodities, gold. And this model right here is just a money maker. It's just a money maker and it's so easy. So easy, right? No time of day, no liquidity sweeps, no nothing. Just a simple, where is the liquidity? Let me follow the trend. That easy, that simple. Okay, so here we are on Nvidia, and we're going to do what we always do. We're going to look for the most obvious liquidity pool, right? Where is the money? Where is the money actually at? So we've got two equal lows. We've got this low here, and we've got this low here. So we know there's going to be lots of liquidity, right? There's going to be lots of people who are going to think this is really good support, right, in this case, right? They're going to think this is good support. So retail traders, those who are losing, think this is support, right? And we all started off using support and resistance, whereas we know this is actually liquidity, right? This is liquidity. There's lots of stop loss orders at this low here. Lots of retail traders think that price is going to come here and bounce off, right? And because it's bounced off here, this is so important. Because it's bounced off here, more and more people are going to buy, thinking their stop loss is super safe here. Now, we do not look at that at all. We actually want to short this, right? Because we know there's lots of liquidity here. We know we've got equal lows. We want to target that because price moves for key highs and key lows on the higher time frames, the 4 hour and above. This is why I tell you, swing trading's a lot easier, right? If you don't go below the 4 hour chart, you don't need to think about time of day. You don't need to think about using multiple time frames. You can just use the 4 hour chart alone, right? So right here, we know there's lots of liquidity at this low and at this low here. Lots of liquidity, essentially at 132, right? Like big figure. Lots of money at that order. Right, we just want to ride price down to this low. And there's actually something a little bit more advanced that's going on here. And I'm going to briefly mention it. Now, I mentioned it before on the channel, but this wick here, right? You see this little, what would you call it? It's like almost like a massive doji. You see how this wick comes all the way up, right? Lots of people, whoever would have had their stop loss orders here, who would have been shorting, right? Their stop loss orders got taken out here. Got taken out, allowing smart money, those in the know, to start shorting price, right? They could start shorting here because their stop loss orders have been taken. Let me make this more obvious here. So right here, we have something called a liquidity sweep. Now, this is probably, a liquidity sweep is probably the more advanced thing in trading, right? One of the more advanced concepts. Liquidity sweep, let's make this a bit smaller, actually. I know, right? We've got a liquidity sweep, right? And the reason why we call it a liquidity sweep is because you see how the wicks come up, taking out all these stop loss orders here, instantly reverses aggressively downwards. The only reason price came up here was because smart money forced the price up so they could take out these stop loss orders here, and then they could start selling, and ride price down, right? That's the actual reason why these huge wicks happen. And you see this all the time, right? And this used to happen to me all the time. Let's say you're bullish, right? We're bullish and we've got price action has been going up like this, right? And let's say there's some key news announcement, and it could be, a stock has the best earnings ever, right? The best earnings they've ever had in history. And massively, the price will drop massively, take out all this key liquidity here, all the stop loss orders, and where your stop loss order probably would have been at this key low, and then instantly reverses, right? The reason it does that, it's not because the market just dropped randomly because they priced in. That's a load of crap. The only reason price comes down here is just to take out your stop loss orders, knowing there's billions of dollars worth of orders there, and then quickly move off in the other direction, right? These markets only exist just to take out people's stop loss orders. That's it. So big institutions can take your place. That's the only reason they exist. It's not designed for me and you. It's designed for those who have billions and billions and billions of dollars, who are on Wall Street, who are in London. Right? That's who it's actually designed for. Who are in Tokyo. So it's not designed for, poor people to make money. That's not why these financial markets exist. It's only to make rich people and even richer. But by trading like them, in a similar style to them, we can make money too. But just know these markets are highly manipulated, and the only reason they move is to ensure that some people can actually get their orders filled and other people will lose so they can get their orders filled, right? I hope that makes sense, right? We move for liquidity only. So we have key liquidity here, right? Retail thinks this is a support. Lots of liquidity here. Lots of people are buying. They're buying Nvidia. They think it's going to go, all the way up to the moon. And we're not looking at that. We're looking for short, right? We're looking to short because we know there's lots of liquidity here. And we're even more confident now that we have a liquidity sweep, because if you wanted to short, right? If you wanted to short Nvidia, where would your stop loss orders be? It would be at these highs, right? It'd be at these highs here. The wick comes up. This is probably a news event. I'm not really sure what it was. Probably a news event. Comes up, takes out all the liquidity here, quickly reverses down. Anyone who went short here has lost, right? They've lost money. Smart money's taken their place. And what happens, right? This is so important. What happens when you lose a trade? Are you like, oh yeah, I can't wait to get back in. I can't wait to lose again. No, you're not like that. Or you're scared to get in. And that's what they want. They want you scared to get in. This is why liquidity sweeps exist, right? It takes a very certain type of person, let's say, if price is bearish, let's say they've shorted, they put their stop loss orders here, price comes up, takes out their stop loss, and then instantly reverses. It takes a very, special type of person to start shorting again, hoping that it goes down. Most people are too scared as price comes up because they think they're going to lose again, right? Rightfully so. They think they're going to lose again, so they don't want to get into position. And this is why these liquidity sweeps exist, especially on the lower time frames. This is why I say, if you want to make money from trading, just stick to the 4 hour and above. By sticking to the higher time frame, you save yourself a lot of pain, because the lower the time frame you go, the more liquidity sweeps, the more fake moves you get. And these fake moves are all designed to essentially break you, right? And, ICT has something called a breaker. The actual reason why it's called a breaker is because it breaks your will. Like, that's the actual reason behind it, because a liquidity comes up, takes out, your stop loss orders, you're demoralized, you don't want to get back into position, right? You see price retracing, but you're already nervous, right? Because let's say price was dropping here, you thought your stop loss was safe, right? Maybe you shorted, and as price was coming up, right? Now price is coming up again. Those who lost here, they're too scared to get into position. They think it's going to come up again and take them out. We know, because there's been a liquidity sweep and it's key liquidity, we're safe and we're happy to enter. We're happy to enter like that, right? We just about get filled. Just about get filled here, right? And for stocks, you can trade with your own money. You can trade using leverage. You can trade using options, and really does not matter, right? It works on all instruments essentially. And we aim for a 3-to-1 like this, right? Like that. Nice, easy 3-to-1. Nice, easy 3-to-1. We enter on a Thursday, and what's that? By Tuesday of the next week, right? About a week and a bit, right? A week and a half, you get a 3-to-1. So if you risk $1,000, you want to make 3K in less than 2 weeks. And I don't think anyone's complaining about that, but this is how you trade stocks, right? The thing is with stocks, right, is because they have a much lower volume compared to Forex, compared to indices like the S&P 500. And the lower the time frame you go, the more and more unreliable price action becomes, right? The more and more unreliable it becomes. So sticking to the higher time frames really helps you with stocks, and it helps you with all markets. Because I do this on Forex, crypto, indices, commodities, and it works on all markets, right? This is probably the easiest entry pattern, or the easiest entry model in all of trading. And you got to think, right? I spent years studying trading. I've learned literally every concept under the sun, and this is what I've settled with. This is what I use, to give me financial freedom, to retire my parents, to change my entire bloodline. It's all on this model. It's all on this model because it's the simplest model in all of trading, personally, that I think. And now, broadly in trading, broadly speaking, there are two things that will hold you back. The first is fear, and the second is greed. Right, and usually people fall into one of two categories. They're either very fearful, they're very hesitant, they don't want to get into trades, they hate losing, and when they go on a losing streak, they start panicking, they get anxiety, they want to change models, and that's exactly what I was like. Right, that's exactly what I was like. I was such a fear-based trader, and I'd be scared to lose, and as soon as I lost, I'd be like, oh, I've done something wrong. I need to change my model. And that held me back for years, really. It held me back for years. I was very fearful. I'd be hesitant to take trades. So let's say I lost a trade, right? And my trade usually was like a fair value gap here. So like I would enter. I mean, this isn't my model, but let's just say this is my model, right? And let's say I'd lost, let's say, 3 trades before. I'd had a 3 losing streak, and this is my model. I would not execute it. I'd be so scared. I'd be here, and I'd be so scared, thinking, oh, what if price like goes up and takes me out, and then goes back down again? Like, what happens then? Like, that is how I used to be. And that is how fear-based traders are. That's how fear-based traders are. They're very hesitant to get into trades. They hate losing. When they lose, they think they've done something wrong. They want to change things. They want to fix things. They usually, in my experience, they tend to be like perfectionists. Right? They may have excelled at school, university, work, whatever they've done. And when they get to trading, they want to control everything, and they want everything to be perfect. And that is what holds people back, in terms of fear, the hesitation and the anxiety that goes with it. And the second one, so if you don't really relate to fear, if you're not really anxious to get into trades, if losing isn't that big of an issue for you, you might fall into the second category, which is greed, right? A lot of traders fall into greed, which is they're greedy, they want to make money, they're not disciplined. They don't follow their trading plan, they over-risk, they over-leverage. So let me give you an example. I know a lot of people on Twitter, they ask me about this because they've got, FOMO, greed, that sort of stuff. Fear of missing out is an element of being greedy, right? It's an element of being greedy because you can't accept what your model gives you, right? Because if you follow your trading model, you've got your trading plan, and you follow it every single trade without hesitation, there is zero thing as FOMO. You should have no FOMO because it's not your trading model, right? Like, I'm a swing trader. I don't care what a scalper does on the 1 minute chart on gold. Like, I don't care. Even if that guy makes like 10K in a day, that means nothing to me because it's not my trading model. I have no FOMO. Whereas people who have greed, they think, even though they've won today, let's say they've won a trade, they think, oh, well, this guy made more money than me. They made more money than me. Let me get into a trade. And, they struggle, they lack discipline. They struggle to follow their plan. And the reality is they're just focused on making money. They're focused on making money too much. And they'll do anything they can to quickly make money. And when you try and quickly make money, you quickly lose money. So like an example of a greed-based trader would be, you see this fair value gap here, right? Let's make this a bigger. Let's say that entry was this fair value gap. And they're on the charts at this point, right? And they see price coming down, and there's no retracement. They see no retracement, right? So prices come down like this. It's come down like this. And they think price is not going to come up and give them a second chance, like it's done it. They don't think that's going to happen because for whatever reason, they're greedy. They think price is going to come all the way down. Because it's going to keep going down. It's going to keep dropping. It's going to keep dropping. It's going to take out, liquidity here. It's going to keep going down. And they don't even think about the possibility of losing because to them, it's all about making money. And what they'll do is, let's say price is here, or it's like around here. Their entry really is supposed to be up here. That's what it says in that entry model. But they're like, oh, you know what? Screw it. I'm just going to enter here and I'm going to target all the way down here. And they target all the way down here. Price, slightly goes in their favor, quickly reverses. It stops them out. And then it goes to their entry. And then usually what happens is their entry is actually right. And it goes to their take profit. And then they're angry. They start revenge trading. They start changing the model. This is what a lot of greed-based traders have. They have this sort of issue where they can't follow their model. They're chasing price. They don't have discipline. They can't wait for it. Maybe they follow their model for a week and then they give it all back, on one trade, the next week after because they can't follow their model. And, greed at its core, it's a lack of discipline. It's a lack of discipline. So for greed, the key thing is you have a lack of discipline in yourself. You can't follow your model. Because you have a lack of discipline. Whereas with fear, the key thing there is a lack of confidence, right? With fear, it's a lack of confidence. With discipline, with greed, it's a lack of discipline. Right? I hope that makes sense. Because that's very, very important. Fear-based traders don't have confidence in themselves. They don't have confidence in their model, and they don't have confidence in the markets in general. Right? And that was for me. I had, a huge problem with just not having confidence in my model. Like I'd lose 2 trades in a row and I'd be like, oh, what if I lose again? What if I lose the next 5 trades? This is what I would think, right? Because I didn't have confidence in myself, right? And it's very, very important as a trader, you have confidence in yourself because, eventually you're going to be putting real money on the line. And depending on how big your ambitions are, your stop loss could be $1,000, $5,000, $10,000, right? If you want to make 10K in a day, and you've got a free risk to reward ratio, you're going to be risking $3,000. $3,000 is a lot of money, and you need to be at a point where you're confident enough to risk that money and lose that money. Right? If you lose a trade and it's $3,000 stop loss, that shouldn't bother you. Eventually, that will not bother you. So, you've got to be at a point, if you're a fear-based trader, where you're confident in yourself and you're confident in your model. And if you're a greed-based trader, if you're greedy, you like chasing price, you get FOMO, you need to develop discipline. And I'm going to give you a solution, right? And this is the key solution. It's journaling. And I know people don't like to journal for whatever reason. But what a journal really is let's say we have the example, right? The trader who was supposed to enter at this fair value gap. He was supposed to enter this fair value gap. And for whatever reason, he sold price down here, chasing price because he couldn't wait for a retracement up. You would get your snipping tool up. I don't know if you guys can see this. Let's just type it in here, right? You'd get your snipping tool. I'm not going to actually do it. You'd get whatever screenshot software you want. You'd take a screenshot of this. You'd put it on a Google Docs and you just type, here is a trade, which I did not wait for, right? I chased price and, price quickly reversed. It took me out and I should have waited here. And you write that down in a journal and you write down how you were feeling and why you did that, right? So you might write down I got into the trade because I thought it wasn't going to come up. And then what you'll see is, let's say you journal for a few weeks, you'll read it back and you're like, oh, it's just a lack of confidence. It's just a lack of, almost experience, right? Because if you think about this, if you see this enough times, you'll be like, oh, if I just wait for a retracement, then I'll be fine. So what you'll see is, in this instance, chasing price is just a lack of almost experience with your model. And the cure for that is backtesting. Right? Backtesting is so important because if you backtested this 100 times, you're going to realize, every time I wait for retracement, I'm profitable over the long run. Where every time I chase price, I lose right away. All right? So that's where a journal comes in. And if you're a fear-based trader, and again, we're going to use the analogy that this is your entry. And, usually what your model says is that your stop loss should be, let's say here, like that. And your take profit should be down here, right? Whatever, 6 to 1, whatever. Entry doesn't matter. But for whatever reason, you've lost 2 trades and you're afraid to get in. You're afraid to get into this trade because you think, for whatever reason, it's going to go up like that. And we're in live price action now, so I don't know what's actually going to happen. But let's just suppose it does this. Let's suppose it goes straight down to your take profit. You're going to journal this, and you're going to be like, due to the previous trades I had, I was nervous, I was fearful, I didn't have confidence in myself, and I was too scared to get into the trade, and now the trade's quickly gone off without me. and it's hit my take profit. Right? That's what you will journal. And then you'll realize over time, over reading your journal, that, oh, it's just a lack of experience, really. It's a lack of experience in my model. Because if you've seen this, again, we're going to go back to backtesting. If you backtest this 100 times, do you know more often than not, when price retraces to a fair value gap and you're bearish, you tend to make money, you're going to execute it. You're going to execute it. So the solution almost always tends to be more backtesting, get more and more confidence. And you don't just backtest once, right? The first initial backtesting is to get your data. So like when I first backtested my model, it was a 50% win rate, free risk to reward ratio. That's like the actual data that you have an edge. And then afterwards, you keep backtesting to get the experience. Because the more and more you can train your eyes, the less likely you are to do emotional things like fear and greed. And yeah, backtesting and journaling are so key. I know people hate journaling. I know they hate backtesting. It is tedious, but I'm telling you, please, if you just take a screenshot of this and you just write like a sentence or two, that will help you out so much. Because I realized, like, I had no idea about any of this, but I read my journal. People told me to journal, so I journaled and I read it back, and I was like, man, every time I lose, I go into a tailspin. Like, I'm so afraid of losing. And what that is, really, at its core, is a perfectionist. Right? A perfectionist tries, because, I'll be honest, everything I've done in life, and not to sound arrogant, like, I tend to succeed at it. I tend to be like almost the best. So for me, being a trader and losing 50% of the time, but still making money, that for me is very hard. Because for me, my brain sees success as winning, right? High win rate, 80, 90%, 95%, let's say. Because if it's an exam, usually I'm getting, high 80s, low 90s. So for me, 50% win rate, that doesn't really, go well in my brain, because it's like I'm going to lose quite a lot. I don't like losing. So for me, fear was such a huge issue because I was a perfectionist, and I had to let go of that. I had to let go of that perfectionist. I had to accept, humble myself, really, that, what, I'm going to lose a lot. And the real loser in trading, it's not price going against you, right? So let's remove this. The real loser in trading, and this is so important, because if you can get this, you can truly be profitable. The real loser in trading isn't, let's say this is your model, it isn't this. That's not a real loser. The real loser is two things. It's either you not getting in the trade because you're so afraid that price is going to go against you, or price literally going down like this and you're too impatient, undisciplined to wait for retracement. So you're just going to enter as soon as possible. You're just going to enter here randomly, buy it, randomly sell and target all the way down there, and then price goes against you. That right there, those two scenarios, is a real loser in trading. That's a real loser in trading, right? But price, you following your model and, price action doing that, that's not a loser. That's not a real loser, because that's exactly what you expect. Because if you truly understand what a win rate is, because let's go off the analogy, you've got a 50% win rate and a free risk to reward ratio like I have, right? That right there is enough to make you a millionaire. That's enough to make you a millionaire, 10k a month, 100k a month, a million a month, or whatever you want. But let's just go off that analogy. You've got a 50% win rate. What that really means, what it truly means, is you have a 50% loss rate. Right? No one talks about this. Everyone talks about win rate, but what's your loss rate? You're going to lose 50% of the time. Right? You're going to lose 50% of the time. 50% of your trades are going to hit your stop loss, not your take profit. And you've got to accept that. You've got to actually accept that. If you don't accept that, you're never going to be profitable. You're never going to be profitable because, even for me, like, I'd backtest it and have a 50% win rate, 60% win rate, and then, as soon as I lose like a trade or two, I'm like, I need to change something. Why? Why do you need to change something? Right? You got to trust your backtesting. You got to trust your edge. You got to trust your data, because you don't have data on your emotions. You don't have data on your emotions, but you have data on your trading plan. And every day your emotions change depending on how you feel. So you can't trust them at all. And if you're like a greed-based trader, so you've got FOMO, you're over-leveraging, you're revenge trading, all that is a lack of discipline. It's a lack of discipline, and discipline is kind of a hard thing because it's a life trait, right? It's a personality trait. It's not just it's not just trading. It's a personality trait. So if you're undisciplined off the charts, you're going to be undisciplined on the charts. Now, what do I actually mean by that? If you get up late, like you don't have an alarm clock, you're getting up whenever you feel like it. Let's say you maybe go to the gym. You half-ass your workouts. You're supposed to go, let's say 6 days a week, 5 days a week to the gym, but you only go 3 days a week. right? You say you're going to do something, but then you're, I don't really want to, you kind of half-ass it. If you do that, and that sounds like you, that's going to show in your trading. It's going to show in your trading. If you're not disciplined, if you don't say I'm going to do something and then do it, you're an undisciplined trader, right? And it doesn't matter whether that's in trading or in life. If you're undisciplined, it's going to show up in the charts. And how do you develop discipline? This is a hard thing. It's a hard thing for a lot of people to develop. But for me, you've got to get the good habits in. Set up an alarm clock, right? Let's say you go to work, I don't know, but you wake up at 7 a.m. every day. On the weekend, make it 9 a.m., 8 a.m. For me, I wake up at 7 a.m. 7 days a week. Every single day. And I go gym every single day. But 3 days I go to the gym, 1 day I have a rest day. Non-stop. That's what I do constantly, right? I don't say, I'm going to go gym today, and I'm like, I don't really feel like it. I'm kind of tired. Like, I would never do that. And you got to make sure you would never do that too. Because if you're that type of guy, you're like, I don't know. And then you go to the gym and you're like, let's say it's leg day. I'm kind of tired now. Let's just do half a workout. Let's go light today. That's undisciplined. That's laziness, right? If you're undisciplined like that, it's going to show up in the charts, right? Because you got to think about it. If you've got a model, a trading model, and it says, if I follow this, if I do this, if I execute here, if I take profits here, my stop losses here, I will be a millionaire. Why can't you do that? Right? It sounds pretty logical, isn't it? You have a trading model that you've proven, that you've back-tested, that's proven to work. You know it works. You've seen it work. Why can't you stick to it? Right? That model right there gives you financial freedom. It makes you money, but you can't stick to it because you lack discipline. And you've got to fix that discipline. Now, journaling will help. Journaling will show you. Journaling is just a proof, right? It's just a proof that you've got, whatever's holding you back. You might revenge trade, right? So you might, let's say for whatever reason, let's say price does this, and you might chase price here, or you might look for like a crappy setup. So you might get a little retracement like this, and then you start selling it, and then price goes all the way up, not all the way up, but let's say it goes up here, takes out your stop loss, and then goes down, and then you get beaten up. And another thing, this is a key one, a lot of people, let's say you risk 1% every trade, right? They might be like, I lost a trade, let me risk 5%, no stop loss, right? No stop loss. That's a lack of discipline. That's a complete lack of discipline. You should be able to show up the charts, take a win, take a loss, completely fine, and move on with your life. That is discipline, and that is confidence combined, because you need both of them to be profitable, right? You need both of them to. You need to be disciplined and confident, or you got to get rid of fear and greed. You'll have elements of both, but like for me as a fear-based trader, I would never risk more than 1%, or I would never not have a stop loss, or I would never chase price. Because for me, I'm too afraid to get in. I'm too afraid to lose, so I would never chase price. In fact, a lot of the times, I'm too afraid to get in on my entry. Price goes up without me, I'm like, at least I didn't lose. That's what I used to be like. I used to be like, at least I didn't lose. Imagine that. Like, I wouldn't take a sell, a valid sell, but I'd be okay with myself as long as I didn't lose. Crazy. So you need to journal that, because I only learned that by journaling. I read it and I was like, what the fuck am I doing? Like, what am I doing? I'm holding myself back. So much unnecessary pain for no reason. And yeah, you want to journal that. And for discipline, so for greed-based traders, you've got to develop discipline, and you've got to do that throughout your whole life. And no one said trading is going to be easy. If you want this, you got to put in a lot of work, and you got to sacrifice a lot, right? Because this is the final hurdle. Now, if you're watching this video, you've probably got a model. You probably trust. You know how to read price. You know what daily bias is. You know what fair value gap is. It's pretty simple. That all you need now is the mindset. The mindset for success. That's the only thing that holds you back. The last hurdle is the mindset. Profitability is right there. Look, it's right there at your grasp. You can literally smell it. Think about it. You can smell it. You can feel it. You can see it. You just need to get over that last hurdle. And you're done. And yeah, I know I've rambled on for a bit, but this is such an important video, and I want you to make sure that you get this. And you might need to watch this again. But yeah, so something that's really helped me out recently is affirmation. I don't know if you know what an affirmation is. An affirmation is essentially, it's like a positive statement that you write down, right? So some unattractive girls, they might write, I am very pretty, I am very pretty, I'm very pretty. Like, that sort of stuff, that almost like a little prep talk you give yourself, right? To give yourself more confidence. Now, for trading, if you write, and I wrote down some affirmations, like, I am a profitable trader. I am a profitable trader. I am a profitable trader. And the one that I personally use is, I am so happy and grateful now that I am a profitable trader. And you might be asking, well, why the heck are you doing that? What's the point in that? Because your subconscious brain, and this is so important, right? Your subconscious brain will hold you back, not your conscious brain. Because right here, this is suppose is your model. I can tell you right now, you've got a trading model and it's profitable, and if you follow it, you will be rich. And you consciously, your logical brain knows that. It knows if I follow my model, I will be rich. But for whatever reason, you can't do that. You can't actually execute it. Now, the reason you can't do that is because of your subconscious brain. And the majority of your brain, 95% of it is subconscious. Right? Conscious brain, the logical brain is only a tiny part. 95% of it is subconscious. And subconscious means it happens automatically. Because it's being deep-rooted programming. Now, you can, with great effort, you can change your subconscious brain. But it takes a lot of effort. A lot of effort. And these affirmations are key. These affirmations absolutely help you out. So, let's say you're a greed-based trader, you're undisciplined, you have FOMO, you can't switch your model. You're going to write down, I am a disciplined trader. And you're going to do that 100 times, or however many times you have. Let's say you've got a notepad. Just fill out the page. I am a disciplined trader. I am a disciplined trader. I am a disciplined trader. Or if you're a fear-based trader like I am a confident trader. I am a confident trader. I am a confident trader. And I've got a list of affirmations. And what you can do, I know this might sound a bit weird, you go on ChatGPT, and you can just say, hey, look, just type in a few things about yourself. Look, I'm a fear-based trader. I'm a bit of a perfectionist. I hate losing. I always doubt myself. Can you just give me like 10 affirmations? And it will give you 10 affirmations based on what you said. And you can just like have that on a Word document and just write them out every day. That's what I do, right? And it really helps you out. It really helps you out because over time, over like a week, within a week, you'll start noticing this. Your subconscious brain will start activating. So let's say I'm a fear-based trader, right? I'm too scared to get in. My subconscious brain will be like, well, actually, you keep saying to yourself, you are a profitable trader. And the key thing with your subconscious brain is it can't differentiate between real and imaginary, right? It doesn't know the truth. Your logical brain knows the truth, but your subconscious brain doesn't know the truth. So if you keep saying to yourself, I am a profitable trader, I am a profitable trader, your subconscious brain is going to force you to act like one. It's going to force you to act like one. That's so important. It's going to force you to act like one. So if I'm on the charts and I'm like, oh, I'm afraid, my logical brain, I'm afraid to get in. But my subconscious brain is like, well, actually, you're a profitable trader. And a profitable trader would get in. And your subconscious brain hates it, absolutely hates it when something goes against it. So if your subconscious brain has been deluded by you writing it down that you're a profitable trader, it hates the fact that you wouldn't be a profitable trader. And it will do everything possible subconsciously, right? So subconsciously means without you actually thinking, to make you profitable. So it will force you to be disciplined. It will force you to act, with confidence in your trade, right? So, and this really helped me out because it's like, my brain was like, well, actually, you are a profitable trader. And I am a profitable trader. And then I would enter the trade, and guess what? It would go in my favor, and I'd be a profitable trader. And then it's more and more positive reinforcement, right? Because your subconscious brain, you've got to change your self-image, right? And your subconscious brain creates a self-image. Now, a lot of you, and I had this for ages. My whole identity was, I'm a struggling trader. I'm trying to make it. If you keep saying, I'm trying to make it, I'm trying to be a profitable trader, I am going to do it one day, that one day will never ever come. It will never ever come because your subconscious brain still thinks that you're grinding. It thinks you want to keep working, right? So what you've got to do is you've got to truly convince your subconscious brain, and you do that just literally by writing down these affirmations and feeling the emotion. You want to convince your subconscious brain that you are a profitable trader right now. Right? But the results aren't there. Don't worry about the results. The results will come. Trust me, the results will come. But you want to write that down, and you want your subconscious brain to believe and delude your subconscious brain to thinking that you're a profitable trader. So you start acting like one. Because for me, my whole identity was, I'm a trader. I'm trying to make it. Well, guess what? My subconscious brain is going to keep me as a aspiring trader, not the trader I want to be, but a student that's always trying to learn. It took me years to stop studying and finally get into the charts. Right, like properly. I was watching like ICT, but I already had my trading model years into it. Like I didn't need to keep watching YouTube videos, but my subconscious brain thought that I was a student. I'm a student. I'm learning how to trade. Well, I'd be learning how to trade forever until I changed my mindset to I actually want to make money from this. I actually want to be a profitable trader. I don't want to be here forever. Right? So you've got to change your subconscious brain, and that's the key because your self-image. This is what we're talking about here. Your self-image needs to be, I am a profitable trader. I am a profitable trader. And I act like one because I am a profitable trader. Not, I can never follow my plan. I've got so much FOMO. I'm undisciplined. If you keep saying, I am undisciplined, guess what? Your subconscious brain is going to make you undisciplined because that's what you keep telling it. Whereas if you keep telling it, I am a profitable trader, I am a profitable trader, I am confident, I am confident, I am disciplined, then your subconscious brain will make you that. And that's the power of, these affirmations. And if you understand that, if you truly understand those affirmations, and you can change your subconscious brain, you can fix fear and greed. You can fix fear and greed. I'm telling you, you can fix it, because that was the final thing that got me to profitability. Is these affirmations. And I know they sound ridiculous, and it sounds weird, but I'm telling you, I don't know what it is, but that will actually help you. It will actually help you. And yeah, please, for your sake and for my sake and for everyone's sake, try these affirmations out. I don't believe in coincidences. If you're watching this video, you're watching it for one very specific reason. You are ready to be a profitable trader. And the first thing I like to say is congratulations, because it's a long, hard, and miserable journey. It's a long, hard journey, and you're finally at the end of it. But there's one last thing you need to know before you become profitable. And this is like a secret that nobody talks about. But the moment you understand this, bam, like that, instantly, you'll become a profitable trader. So in this video, I'm going to tell you exactly what that is. Okay, so what is this secret that I'm talking about? The secret is, and this is so important, you need to see yourself as a profitable trader mentally before you actually become a profitable trader. Now, what do I mean by that? Right, I titled this video in a bit of a clickbaity way because first of all, I want to get views, right? The second reason is because I titled it, I don't know what the title is, like, you'll find this video when you're ready to be a profitable trader. I titled it in such a way where the only people who would watch this video are people who want to be a profitable trader, but they don't see themselves as a profitable trader already. And this is so important, right? Because I was trading for about 2 years, about a year and a half, right? I put in so much work. I'd spent literally all my weekends. Every night I got back from work, I spent all my time studying. And for whatever reason, I could not make money. I could not make money with trading. I kept losing. I kept blowing accounts, and I didn't know what was happening. And what was happening is I knew all the theory, but mentally, I didn't see myself as a profitable trader. So I can never actually become a profitable trader. So I'm going to show you how you can actually fix that. Okay, so what am I actually talking about, right? There's essentially two parts to your mind. And this is so important, right? Because trust me, if you've been trading for more than a year and a half, another trading strategy isn't going to make you profitable, right? Another fair value gap, another liquidity sweep, and an optimal trade entry, that's not going to make you profitable. This right here is going to make you profitable, right? This is your mind, right? I don't know if you've ever seen this picture before, right? But this awful circle here is your mind, right? Like, forget how dodgy it looks, but there's two layers to your mind. And your mind is not your brain, right? Your brain, its job is just to keep you alive, right? Like me speaking, I think in my brain, and then my brain produces the voice, right? There's no miracle to your brain, but your mind is the miracle. And there's two parts to your mind. The first part is the conscious part of your brain. This is the thinking part. This is called your educated mind, right? So all your technical analysis is stored within this conscious part of your mind. So all your, let's say ICT, all the ICT videos you've watched, right? All the SMC videos you've watched, whatever, style of trading you do. So, let's say VWAP, right? All the volume stuff, everything you know about technical analysis is in the conscious part of your brain. But there's another part, of your mind. But there's another part of your mind called the subconscious part, right? And this is a key. This is absolutely key because nobody talks about the subconscious mind. Everyone knows about the conscious mind. Inside your subconscious mind, this right here is what's keeping you unprofitable. And this is where your FOMO is, right? Where your, let's say, greed is. Everything that's holding you back psychologically is inside this subconscious mind. And when traders say, oh, trading's like 90% psychological, what they're really talking about is they're talking about this subconscious mind here, right? Everything that's holding you back in trading and in life is within this subconscious mind, right? And why is this important? Why am I telling you this? This key fact right here is the most important fact like I probably have ever learned in my life, right? And I'm going to write this down for you. 95% of your results come from the subconscious mind, right? It does not come from the conscious mind, where all your knowledge of technical analysis is, where all your knowledge of ICT, SMC, VWAP, all that sort of stuff, right? It does not come from there. It comes from the subconscious mind, right? Your results in trading and in life, it comes from the subconscious mind, right? These two are interlinked. All your results come from the subconscious mind, right? So, like I said, if you've been training for, a year, more than that, and you keep finding yourself unprofitable, this is what's holding you back. This is the last thing in trading that is holding you back. And the key thing, in fixing this is instead of seeing yourself as someone who's trying to learn how to trade, You need to see yourself as a profitable trader already, right? And that's absolutely crucial, right? Okay, so how do we do this, right? How do we actually get into our subconscious mind the idea that we are a profitable trader? Because what we really want is we want it to say, I am a profitable trader. And we want our subconscious mind, let's just neaten this up a bit. We want our subconscious mind here to believe that we are a profitable trader, right? Because so many traders will message me saying, hey, look, I've got FOMO, I've got greed. You should never, ever, ever say, I have, and then something negative, or I am, and then something negative afterwards. Because when you say that, it goes straight into your subconscious mind, right? You think about it, you think with this mind here, you think about it, oh, I'm greedy, I've got FOMO, and it goes straight into here, right? It goes straight into here. The conscious, whatever you think in your conscious mind, goes straight into the subconscious mind. And then the subconscious mind will display it in the form of results, right? Your results, your trading results, is this. This is your trading results here. Now, if you aren't a profitable trader, and like I said, if you've been trading for more than a year, definitely more than 2 years, this is what's holding you back. It's your subconscious mind. It's how you see yourself. And like I said, I titled this video in such a way that you click this video if you wanted to be a profitable trader. Right? You go, if I watch this video, I'm going to become a profitable trader. You don't see yourself in your subconscious mind as someone who already is a profitable trader. And that's what's holding you back. And this took me about 6 miserable months to finally find this out, right? It was inside my mind. I had mastered ICT. I'd gone through the 2021, 2022, 2023, and like part of the 2024 mentorship. I still couldn't make money, right? I still couldn't make money. And it was all because inside my subconscious mind, I did not see myself as a profitable trader. And within a month of fixing that, I was on a winning streak, right? And I didn't know, when you're on a winning streak, you don't know, am I going to go back to normal? Within 2 months, I'd passport firms. I was on 10K a month. Like, I was going to the moon. Do you know what I mean? I could easily and confidently say that I was a profitable trader. And, this was a light bulb moment for me. Okay, so how do we fix this, right? It's all well and good, me saying this. How do we actually fix this? And there's 2 ways that you can do it. There's 2 ways. And let me just write this down here. The first one, and you've probably heard about this all the time, right? Like visualization, right? Visualization. Now, visualization, literally, you close your eyes and you imagine yourself being a profitable trader. You literally close your eyes now. Imagine yourself getting a payout from FTMO, and the fibers, TopStat, whatever, and just imagine yourself, confidently coming on the charts. You know exactly what you're looking for. You know where your stop loss is going to be. You know where your take profit is. You're always following your model. Even if you lose, you're like, yeah, whatever. I know another winner's going to come. You're so confident in yourself, right? So when you visualize, you close your eyes, and you imagine yourself being the trader you actually want to be, right? You imagine yourself being the profitable trader, right? And the key thing is, you've got to convince your mind, and you've got to just act like a profitable trader, right? A profitable trader isn't going to say, I had a loss. A profitable trader is going to say, yeah, of course I've had a loss, right? It's part of my edge. If I've got a 60% win rate, 4 out of 10 trades I'm going to lose. Like, who cares, right? I aim for like a free risk reward ratio. You're going to be profitable, over the long run. That's what, a profitable trader says. They have confidence, right? Do you have confidence in yourself? Like, really, you've got to have confidence in yourself. You've got to become a profitable trader before it actually manifests. And the second part, and I like this, right? This is what helped me, is affirmations. You spell this right. Affirmations. Now, affirmations is literally when you just say something over and over again, like, I am a profitable trader. If you literally write down, I am a profitable trader, like 20 times a day on like one side of a notepad, you will become a profitable trader within like 3 months, assuming you actually know the technical analysis side, right? If you know the technical analysis side, within, maximum 3 months, you'll be a profitable trader and you'll be passing problems. Within about 2 weeks, you'll notice like instantly everything's changed. You no longer got FOMO. You no longer got greed. You seem to have a good luck, right? This is something that, everyone who does this will say, right? You'll seem to have good luck. You'll seem to have lots of more winning streaks, right? And you think, is this normal or not? And the reason why is because your subconscious brain is changing, right? And like we said, with the subconscious mind, 95% of your results come from here. It does not come from all your analysis. It does not come from, all the ICT videos you've watched. It comes from your subconscious mind and how you see yourself. So if you literally write, I am a profitable trader, or like I used to, I write down, let me just quote this, I am so happy and grateful now that I am. And let me tell you something, the phrase I am is so important. Let me just finish writing this off, right? I am a profitable trader. The phrase I am is so important. If you say I am and something positive over time and by the law of attraction, that must come true. The exact same way if you say I am and then something bad. So if you say, I'm just not disciplined, or I just got FOMO, by law that must happen because it goes into your subconscious mind. And the subconscious mind will present you the results, right? So never ever say, people message me all the time. Let me just finish this quotations off. People message me all the time saying, oh, I've got FOMO, I've got greed. And right away, I'm like, never, ever, ever say that. Because if you say that, it goes into your subconscious mind. And then your subconscious mind thinks, oh, we have FOMO, we have greed. Time to express that, right? Time to actually manifest that as results, right? So the subconscious mind, make this clear, the subconscious mind will present all results. All results come through the subconscious mind. Conscious thinking brain, subconscious mind, results. Right, so for me to change my self-image from a guy trying to learn how to trade, because that was my whole identity for years, was, look, I'm trying to learn how to trade. I'm trying to learn how to trade. You can't, if you want to be a profitable trader, you got to stop saying that. Stop saying, I'm trying to learn how to trade, because your subconscious mind is very stupid, right? It's going to think that you want to learn how to trade, not that you want to be a profitable trader. You want to be someone who enjoys watching, fucking ICT's lectures, right? You don't want that. You want the results, right? We came here for the results to make money. You're going to tell your subconscious mind and believe it that you're a profitable trader. So for me, I literally wrote this down. I'm so happy and grateful now that I'm a profitable trader. Now, the two key things here is happy and grateful. When you say happy, you get emotionally involved. And the language of the subconscious mind, it's emotions, right? When you get, if you just close your eyes and you just get happy, right? If you just visualize yourself getting payouts, right? Payouts after payouts, changing your life, retiring your mom early, you're going to get happy. And then that emotion goes into the subconscious mind. The only way you can communicate with the subconscious mind is via emotion. Whereas the conscious mind, the only way you can communicate with it is logic. So let's write this out, right? Logic communicates with the conscious brain, right? This is your thinking brain. You went to school, they taught you, how to think, right, via your conscious brain. And the subconscious brain is all emotions. It has no logic to it. Because if I told you logically, hey, do you want to be, do you want to have fear? Do you want to be a guy who can't follow your trading model? You're going to say, of course not. Of course I want to make money. But subconsciously, it's going to be deeply embedded in there that you have fear, that you've got greed, that you've got FOMO. And that's the issue, right? You connect your subconscious brain with your emotions. So when you write this down, I am so happy and grateful now that I'm a profitable trader. You get all those positive emotions and it goes into your subconscious brain. Similarly, right, if you're visualizing, you getting payouts and stuff, that goes into your subconscious brain and then it must manifest as results, right? By the law of attraction, it must manifest. And the law of attraction is real, right? I'm not wasting your time. It works on literally everything. And I don't know if you're following me on Twitter, but within a month, I added 7,000 followers just by using that. Because I'd write, I'm so happy and grateful now that I have 10,000 X followers, right? And bam, just like that, within a month, I've got it. Yeah, so this thing works really fast. It works really fast. And the only caveat is assuming that you actually know that technical analysis, right? Because I'm assuming, if you're watching this, you probably have an understanding of technical analysis. And, if not, don't worry, there's videos on the channel and I've got a full step-by-step course in the description below and it's on sale, so you may as well check that out. If, of course, you don't know how to trade. But if you know how to trade, if you've been training for, let's say, definitely 2 years, this is what's holding you back. This is what's holding you back without a doubt. And this affirmation right here, writing this out every single day, especially when I was back testing, this made me a profitable trader. This is what made me a profitable trader. Right? When people say, what made trading click for you? What was your light bulb moment? It was this. It literally was this right here, right? And, there's a guy called Bob Proctor on YouTube, and definitely watch that guy. Obviously, he's passed away, so God bless him and everything, but his videos really helped me out. And, this sounds interesting, and hopefully it does, because, if you replace I am a profitable trader with I am rich, or, I am confident, or I am attracted to women, the exact same thing will happen. The exact same thing will happen. These results will come true. But for me, the affirmation now has changed because I'm a profitable trader. It's, I am so happy and grateful now that I'm a 7-figure trader who consistently gets payouts, right? That's a pretty nice affirmation, isn't it? Because, if you keep saying that long enough, it comes true. So, you might be a profitable trader, right? But you might get scared, when you do prop firms, right? You might get scared. You might be, it's a lot of money. It's a lot of money. And it is a lot of money. You can have an affirmation of, I am so happy and grateful now that I'm a funded profitable trader who consistently and easily gets payouts. If you say that and you write that down, I guarantee you within a month you'll get your first payout, right? Because all it takes is literally about 2 to 3 weeks. Let me write this out. All it takes is about 2 to 3 weeks, right? 2 to 3 weeks of doing either affirmations or visualization. If you do both, like within 2 weeks, bam, everything will change. Everything will change. And there's no harm. There literally is no harm. It takes like 10 minutes a day to just write this out. I'm so happy and grateful now that I'm a profitable trader. I'm so happy and grateful now that I'm a funded profitable trader who consistently receives payouts. and obviously change it to whatever you want, but make sure you have I am so happy and grateful now that I am, and then whatever you want afterwards, right? I am rich, I am wealthy, I am confident, I am sociable, I have lots of friends, I'm attracted to women, all that sort of stuff. Anything after this will come true as long as you get emotionally involved, as long as you feel the positive emotions with it. And yeah, by law, it comes true. I think this honestly blew my mind. Blew my mind when I've done it, and I'm using it from literally everything in my life, and it's working. And yeah, really good, really good. I hope you enjoyed the video. If you did, make sure you like and subscribe, and leave a comment. Let me know like what you actually think of this, or you think I'm crazy or anything. But yeah, and of course, if you genuinely don't understand technical analysis, if you don't know how to trade, if you haven't got a trading model, it's a full course, link description below, and it's on sale, so you may as well check it out. But other than that, I'll see you guys next video. Peace.